Decision, Tom McKenzie in London.
And here are your top stories. The Fed takes aim at inflation. The central bank raises by 75 basis points. It is the biggest hike since 1994, risking an economic slowdown.
I do not expect moves of this size to be common. From the perspective of today, either a 50 basis point or a 75 basis point increase seems most likely at our next meeting.
Supersized relief. Stocks snap a 5-day rout and yields slide as Powell soothes Wall Street, but the post-Fed rally cools in Asia. A tough act to follow. Attention now turns to the SNB and the Bank of England, with both expected to keep up the focus on the inflation fight. Let's check in on these markets then. The futures had earlier on the session been pointed to some solid gains. They have paired that then. You had the relief stateside on the back of the fact that some investors are now expecting the Fed finally, you would argue, to get a grip on inflation with that 75 basis point hike, the biggest since 1994. Jay Powell came out and said that hikes of that size will not be common going forward, but he kept the door open to 50 basis points or 75 basis points at the next meeting in July, and continued to stress what he sees as a relatively resilient economy, even as the Fed downgraded their forecasts for the trajectory of growth and increased their forecasts for inflation and further weakness, or at least a little weakness around the jobs market. Of course, the jobs market very tight in the US, and he underscored that, but looking at maybe a 4% rate in terms of unemployment next year. In terms of the read across then, that relief was short-lived, because you're seeing losses now here in the UK of around 0.6% as we look ahead to the Bank of England, expected to hike by 25 basis points. But will the hawks start to make their case now, given what we're seeing from the ECB and the Fed as well, as they try and play catch-up? The France and the CAC Garant, you're seeing gains there of 0.5, losses, I should say, of 0.5%. The Italian FTSE MIB down at 0.5% after we saw some strength for the Italian index yesterday on the back of that emergency meeting by the ECB, the outlining of plans for some tools to deal with the risks of fragmentation. The Spanish IBEX down 0.1%. Let's switch it on and see how things are playing out. Of course, there was a lot of move in terms of money moves into the Treasury curve, the US Treasury curve yesterday. Some of that has come off in the session today. In terms of the US 2-year, 327, so yields are up 8 basis points in the session. S&P futures pointing to losses of close to 1%. You did see the S&P 500 breaking the back of 5 days of losses yesterday. They ended up 1.5%. NASDAQ futures, or in fact the NASDAQ ended up more than 2%, but it looks like there will be losses in store for US markets according to these futures. The Italian 10-year, that remains of course in focus, because we know how central it is to the thinking now of the ECB, given that emergency meeting yesterday. There was some relief again in the Italian bond markets on the back of the news that they are starting to pull together a plan to address the risks of fragmentation. 379 on the Italian 10-year, not much movement there. The pound, of course, in focus for us today, ahead of the BOE, 121, down by 0.6%. Kit Dukes from SocGen earlier telling us that he sees a lot more further downside for sterling. Francine, you are focused on the SNB, where, for once, it's going to be an interesting meeting.
It is. I love it. So I landed, and actually you speak to a lot of analysts, you speak to market commentators and say, this is an exciting S&B. So if you look at the feverishly hike across the world when it comes to central banks, what does that mean for S&B? We are expecting them to really try to put the spotlight on inflation. But when you look at the inflation numbers, Tom, it's very clear that inflation here in Switzerland is nowhere near what we're seeing in the Eurozone or in the US or the UK. It's around 2.9%. Now, if you look at some of the volatility in Swiss franc, look, I have to say, it doesn't happen very often that currency option traders get all excited about an upcoming meeting of the Swiss central bank. But again, it's this feverish global tightening backdrop that's playing out in full glory. I also had one trader tell me, look, it's all going to play out on Swiss yen, so look out for that. So let's go over now to our Bloomberg MLive managing editor. He is Mark Cudmore, and he has more on the markets post-Fed. Mark, what are you looking at?
Basically, I'm looking at the fact that it's pretty bleak out there. We're not seeing great price action. On this screen, you can see the white line is the NASDAQ futures, and the yellow line is Bitcoin. And you can basically see that there's been no real bounce. It's a kind of very much of the dead cat variety of bounce out there. And I think ultimately the next big move again is for lower. If you looked at the Fed meeting last night, there was nothing there that you take away and kind of go, that's given me something to buy off. There was no positive news to leap out of it. And therefore, we go back to the underlying trends and the underlying backdrop. And the underlying backdrop is growth is slowing around the world, financial conditions are tightening, we still have a war, we have an energy crisis, we have a food crisis. The macro backdrop is relatively bleak, and some assets are still very frothy and with excess valuations and still have a lot more downside. So I guess to the simple question of, are we there yet? Have we seen the capitulation? No, we have not. And I think some more pain will come as soon as the next 2 days.
Okay, watch the next 2 days. The dead cat bounce there is the way that's being articulated by Bloomberg MLive managing editor Mark Cudmore. Thank you for breaking that down for us. Now to the ECB, which says it is working on a new tool to curb market stress. It follows that emergency meeting yesterday, convened after Italian yields surged to the highest since Europe's sovereign debt crisis. We are also watching, of course, the Bank of England. It is set to deliver a 5th consecutive rate hike today, with officials expected to stick to a steady path amid global chaos. We will get to Bloomberg's UK economy reporter Lizzie Burden, who is outside the BOE, in just a moment. But first, let's bring in our Europe correspondent, Maria Tadeo, in Brussels, who was watching all of this action yesterday in this surprise meeting from the ECB. What exactly did Madame Lagarde and co deliver yesterday, Maria?
And Tom, it was quite a day, wasn't it? I think that when you look at the statement that came out from this emergency meeting, of course, they reaffirmed the flexible nature of the reinvestment of the PEP program. But of course, that was very well priced in. It was very expected. I think the real takeaway from that statement was that promise, that pledge to now conclude the completion of a new anti-fragmentation tool. Of course, a lot of this in a week in which we saw those real jitters in the periphery, particularly across the BTPs. Now, there's a lot of details we don't know about this. We don't know the timing of the tool. We don't know the structure of it. Of course, a question around this is the type of conditions, the conditionality that will be applied to it. But Tom, I had a contact yesterday who I think really encapsulated the situation very well. When you look at the statement, it doesn't give you reasons to buy, but it does not give you reasons to sell either. If you're the Italian central bank, for the time being, that is probably good, and it really has stabilized the situation. If you look at BTPs today, I think the real takeaway, however, will be what is the conditionality, but also what does it mean for the rate hike path? Will this be used as a way to say, well, we now have the no fragmentation tool, let's go faster on the rate hikes?
Yeah, the concern, of course, Maria, is that markets will just keep on testing the resolve of the ECB until they get something. Let's also go to Lizzie Burden outside the Bank of England. So, Lizzie, how the BOE actually balanced the recent UK economic data, because the economy is pulling it in two directions. So there was something for the hawks, but there was something for the doves as well.
You're quite right, Francine. It's not likely to be the same fireworks out of the BOE today as we've seen from the Fed and the ECB. Here, the debate on Threadneedle Street is more between 25 and 50 basis points. And on the one side of the ledger for the hawks, you've got CPI running at 9% in the UK, only expected to hit double digits later in the year. That's swallowing wage growth. Inflation expectations are up. And the Chancellor, Rishi Sunak, since the bank's last decision, has announced more fiscal support, which even he admits is going to be inflationary, though it will boost growth. Now, on the other side of the ledger for the doves, the economy has unexpectedly contracted, consumer confidence is down, the housing market's starting to slow, and you could say the same for the labour market, signs that it's just starting to lose some of that tightness. So it's a recession in all but name in the UK, and that's why we're expected to see the officials take the cautious path, 25 basis points. It'd take the key rate to 1.25%, an unprecedented 5th straight hike from the BOE.
Lizzie, to what extent does the Fed decision, though, in that emergency meeting from the ECB, which some, including Deutsche Bank, argue gives them the flexibility to go harder on hikes, put the pressure on the BOE and, in fact, arm the hawks to push for a bigger hike?
Well, it might bolster the hawks, and the hawks who could come out at this meeting would be Catherine Mann, Jonathan Haskell and Michael Saunders. They're who have voted for 50 basis points in previous recent meetings. You might also see the Deputy Governor Dave Ramsden join them. He was pretty hawkish when we spoke to him since the last meeting, surprised the markets, moved the pound, and that was even before Rishi Sunak's latest package. It'll be interesting to see whether you see a revision to the growth and inflation forecasts or hints at, because they can't change the forecast this time. And also it'll be interesting to see any hints at what the future rate path could be. Our economists reckon you're going to see 25 basis points, successive hikes until November, and then pausing at 2% then.
Lizzie, thanks so much. Lizzie Burton there outside the Bank of England. Of course, our Europe correspondent, Maria Tadeo in Brussels. I'm here in Zurich covering the S&B for you, Tom. And the question here is that investors are wondering how long the governor of the S&B, Thomas Jordan, can push against this global tightening cycle. Again, Switzerland first has the lowest interest rates in the world, minus 0.75%. They haven't moved in more than 10 years. And the question is, can they allow the franc to appreciate a little bit to make sure that they deal with inflation sooner rather than later?
Absolutely. It's remarkable, isn't it? And even if they don't act today in terms of increasing rates, we're going to be watching, of course, and I know you will be, the language around the Swissy from Thomas Jordan and co, given what they've said about the valuation, of course, of the Swiss franc in previous meetings. Let's get to some of the corporate movers of the day, some of our stocks to watch. We've got Veolia. We're starting there in terms of the regulatory front. So this French environmental services company saying that it now plans to sell the Suez UK waste business. It was and is in the business of planning to, in the process of buying up the Suez business here in the UK. They're saying, describing it as a drastic decision in response to what they describe as intransigence from regulators here, and they say that they deplore the lack of understanding relating to the sector from UK regulators, gaining 0.2%. ASOS, though, really being hit on the back of revising down its profit guidance. It had seen sales of 10 to 15% for this year. It's cut those back now, the forecasts, to 4 to 7%, and you're seeing that stock crushed on the back of that, down 14%. Of course, the online retailer Shaftesbury down more than 6% after agreeing an all-share merger with Capital and Country, valuing Shaftesbury at around £2 billion, but stock lower by more than 6%. We'll keep across more, of course, of the corporate stories as well as the macro for you as we walk through the rest of this hour. Okay, plenty more coming up with, of course, the markets here in Europe lower by 0.4%, and the future stateside, the S&P E-minis pointing to losses of more than 1%. Stay with us. This is Bloomberg.
The Indian city of Jamnagar is a money-making machine for Asia's richest man, Mukesh Ambani. His company Reliance has the world's biggest oil refinery complex here in the city. Jamnagar is also where Ambani is making his newest bet, a $10 billion investment in green energy. His ambition is closely aligned with the Indian government's plan to reach net zero emissions by 2070. But Ambani is not alone. India's second richest man, Gautam Adani, has committed $20 billion of investment over the next decade. But India's massive dependencies on fossil fuels have some environmental advocates questioning the realism and sincerity of those green ambitions and those of its two biggest billionaires.
What's happening on Wall Street?
It's the basic law of economics.
It validated what the market was already pricing.
Need to catch up?
This is Bloomberg Wall Street Week. I'm David Weston.
We've got the information and insights.
David, you just hit the nail right on the head.
From businesses most influential and instrumental.
And that's the way you run good risk management.
It's a challenging dynamic.
We could continue to see that kind of strength.
Bloomberg Wall Street Week premieres Friday with replays all weekend on Bloomberg Television and Radio.
We're strongly committed to returning inflation to our 2% objective. Inflation has again surprised to the upside. Some indicators of inflation expectations have risen, and projections for inflation this year have been revised up notably. In response to these developments, the committee decided that a larger increase in the target range was warranted at today's meeting. Clearly, today's 75 basis point increase is an unusually large one, and I do not expect moves of this size to be common. From the perspective of today, either a 50 basis point or a 75 basis point increase seems most likely at our next meeting.
So the Fed has made its bumper move, hiking 75 basis points, the U.S. Central Bank's biggest rate hike since 1994. The chair, Jay Powell, asserted the Fed's commitment to reining in price pressures, indicating another big move in July, Tom.
Okay, for analysis, we're going to bring in Charlotte Ryland, co-head of investments at CCLA, who joins us in the studio. Charlotte, let's just start there with that move by the Fed. Not a big surprise after, of course, they geared the markets up for their 75 basis points in the last few days. What is your assessment, though, of what you heard from Jay Powell, that decision around 75 basis points, and what it means about the Fed's ability or inability to start to contain this inflation?
I mean, I think they've had to go for the big guns at this point, and they're going to continue pushing the interest rates up. I suppose they have the benefit compared to the UK or Europe of having somewhat of a stronger economy to use that for anyway, and I think that gives them a little bit more flexibility in terms of pushing those rates up. But I think, if you look at the dot plots, it's now going sort of 3.4 up to 3.8 for next year. I mean, the long-term rate still, it's looking quite low on those projections, so potentially there's some uplift to come from there as well.
Charlotte, a lot of the market move, of course, happened before the decision. What happens in terms of market correction from here? Are they once again going to test some of the, the way that central banks deal with inflation?
I mean, I think the big worry for markets is going to be thinking about not just, do rates move up, but are we going to be pushing the economy into recession? And that's always been the sort of the big debate. I think, clearly for UK, Europe, it's a much more difficult situation, particularly because of Ukraine and the gas prices. In the US, I'd have thought the risks that we move into recession are going to be increasing at this point, because you're going to be starting to think about things like credit, things like the mortgage market, housing, and whether those begin to move into a more difficult place. At the moment, unemployment extremely low, consumers seem in a reasonably good place in terms of spending, but you have to think that as we move into the second half, that's going to start getting a lot more difficult. 3.4%
by the end of this year, 3.8% next year, significantly above the neutral rate, which is estimated to be somewhere in the twos, mid-twos. What does that mean for the re-rating of equities?
I mean, I think we've moved a long way in terms of equities. I mean, the S&P, I think, was at 23 times at the beginning of last year, down to about 17 times now. But, I mean, is that cheap? I'm not sure it quite is there yet. I think there is still scope for it to move further down, particularly as you start pricing in those higher discount rates.
How much further, Charlotte, does it need to go down for it to be cheap?
That's a $1,000 question. I mean, I think, another 10, 15% possibly to move down. I mean, it's going to depend on individual stocks will start flashing cheap for you. But, I think there's still downside risk there for the markets.
What does it do in terms of earnings? The focus on margins has been central, hasn't it, for investors this year? And in terms of the likelihood of further downgrades as we look into 2023 then, how are you assessing the impact on earnings and where you're finding safety when it comes to the margin?
Yeah, I mean, I think for us, there are areas like some of the consumer staples still have a degree of pricing power, still seem to be, dealing reasonably well with it. Areas like pharmaceuticals has been a sort of obvious safe haven. I suppose the trouble there is, you have to build in the pipelines that those businesses have got as well. Things like telecoms have done well as a sort of safe haven. But of course, the problem with it, if you move too defensive in some of those positionings, is that as the economy begins to recover, when that happens, those aren't the companies that have decent levels of growth, and you don't want them to get bid up too much in terms of their valuation premiums.
Charlotte, thank you so much. Charlotte Ryland, their co-head of investments at CCLA. And we're about, Tom, 12 minutes away from the S&P, and you can see we're in the new Zurich studio, first of all. It's absolutely fantastic. It's our new office, and you can see the excitement. It's really palpable to see what the S&P does in about 10 minutes. Now let's get straight to the Bloomberg Business Flash with Angel Feliciano. Hi, Angel.
Hi, Francine. Air India is said to be asking pilots whether they want to be trained to fly Airbus A350 jets, indicating that it intends to operate the model. The airline is looking to renew its wide-body fleet under new owner Tata Group. According to a letter sent to senior cockpit crew and seen by Bloomberg, Air India may introduce the A350 by the first quarter of 2023. Air India is said to be looking to order around 20 of the aircraft. Cathay Pacific is planning to recruit 4,000 staff between now and the end of 2023 as it gears up for an anticipated recovery in air travel. CEO Augustus Tang tells Bloomberg that the airline plans to bring in 700 pilots and about 2,000 cabin crew, with the remaining positions open for frontline airport staff. Tang also says Cathay will be flying to more than 60 destinations by the end of this year. BHP Group will scrap a plan to exit from thermal coal. It says it will instead aim to extend the life of its final mine from 2026 to mid-2030. Coal prices have been surging and investor attitudes shifting on the sale of fossil fuel assets. The world's top miner has been reviewing its options for the Mount Arthur mine in Australia's New South Wales state for about 2 years. It said on Thursday that it didn't attract a suitable offer for the asset. And it's the end of an era for Revlon. The cosmetics giant owned by billionaire Ron Perelman has filed for Chapter 11 bankruptcy, unable to manage its heavy debt load amid the supply chain crunch and steep inflation. It listed both assets and liabilities of as much as $10 billion. The 90-year-old company suffered during the pandemic and faced years of declining sales as consumer tastes change and upstart brands ate into its market share. And that is your Bloomberg Business Flash.
Okay, Angel Feliciano here in London. Thank you very much indeed. Coming up, the Bank of England is set to deliver a 5th consecutive rate hike today, with officials expected to stick to a steady path amid concerns about inflation and slowdown in growth. More on that story next. This is Bloomberg.
Front Row, exclusive interviews with the most influential figures in finance. Lloyd Blankfein.
Deflation is a terrible thing. Inflation you could tolerate.
Kathy Wood.
Tesla will be in the pole position to dominate.
Jeremy Grantham.
We've had a very, very abnormal honeymoon Goldilocks period.
First available on the Bloomberg Terminal, then on Bloomberg Television and Bloomberg.com. Front Row, the best seats in the house for business's greatest minds. Why do the biggest names in business choose Bloomberg?
That is a great question.
It's a great question.
It's a great question.
Great question. Great question.
Great question.
Great question.
That's going to be the best question I get all night.
I'm glad you asked that.
Bloomberg Television. Top experts. Great questions.
Welcome back to the Open. We are 23 minutes into the European trading day. So much for the relief that we saw yesterday. Short-lived. You're seeing losses of almost 1% across the benchmark European stock 600. And the futures stateside S&P E-minis pointing to losses of 1.5%. It was all about the Fed and the ECB yesterday. Today, it is the Bank of England. Here in London, of course, the central bank is set to deliver its 5th consecutive rate hike today, with officials expected to stick to a steady path. The decision comes against the backdrop of a global rout in financial markets and soaring inflation. Charlotte Ryland, co-head of investments at CCLA Investment Management, is still with us. Charlotte, 25 basis points is the consensus. Is there an argument, though, that given the Fed response yesterday, given the ECB has now arguably given itself some space to go harder on hikes because it's outlined plans for this fragmentation tool, or anti-fragmentation tool, that the BOE has to now play catch-up? Even if it was early out with the rate hiking cycle, they're going to need to step up rate hikes, particularly because of the pressure on the pound and what that means for imported inflation.
Yeah, no, absolutely. I think they're in a very difficult spot now because they can clearly see they've already had a weak GDP print. I imagine it's going to get worse as we move into the second half of the year. But equally, they've got some of the highest inflation around there. You know, the Bank of England has already talked about 10% inflation coming through, and we've got another big, obviously, gas price increase coming, electricity price increase coming through in the second half. So I think they're in a very difficult position, and they, you know, there's the short-term pain of pushing up rates, but there's the long-term issue. If you let inflation get out of control, and we get back to the 1970s, there's obviously a much, much worse situation. So,
Charlotte, are there parallels actually with what we lived through in 2008? Are we going to see a credit crunch? Are people not going to be able to pay their mortgages? And is Revlon a case in point where even big companies, if they don't have the right balance sheet, with disinflation, supply chain issues, will have to close down?
Yeah, I mean, I think if you have got yourself in a very precarious situation in terms of your balance sheet, if you're a company that isn't actually generating any cash flow, that is going to start asking some big questions. So I would expect you will see some casualties beginning to come through. And I think it's very important for investors to actually think about, you know, the balance sheets of the companies that they own and make sure that they have that dry powder and that flexibility to deal with what's going to be a very difficult situation.
Do you have a view on the pound and when it may get back to kind of pre-Brexit levels as we look back to the BOE?
I mean, I think the pound, if you look against the dollar, it's clearly been very weak, but you know, the dollar's been strong against almost every currency, and that's obviously a reflection of, you know, the interest rate policy there and the fact that it's the safe haven currency in the world. So in terms of sterling, you know, I don't think there's probably a great deal of enthusiasm in the markets for UK assets at the moment, given the economy and given, you know, the lower interest rates. So I think, you know, there is scope for it to be to a degree weaker. There are some people talking about parity, and that's probably a little extreme. But yeah, downward pressure continuing.
All right, Charlotte, thank you so much for joining us. Charlotte Ryland, there, co-head of investments at CCL Investment Management. Now, we'll have plenty more, of course, throughout the day on some of these stories. I'm looking at the S&P. I have to say, economists predicting no change from the Swiss National Bank. Tom, that's coming up in a couple of minutes. But the suspense implied in the markets makes it one of the most exciting meetings for the S&P in recent history.
The excitement growing ahead of that SMB decision, of course, and Francine is on the ground to monitor all of that for us. Coming up, we're going to be speaking crypto with Binance CEO Changpeng Zhao. That interview is next. This is Bloomberg.
The end of the year, but Bali is still quiet and empty. I am here in Kuta Legian, one of the main walking streets here that is used to be a tourist spot for beach, dining, shopping, But many shops here are still closed. Most of the outlets are either for rent or for sale as they have run out of business.
Saya kerjanya di sini udah lama, udah ada 10 tahunan di sini kerja. Masih sepi sih, nggak kayak dulu. Kalau dulu kan rame, sekarang ya ada, 1-2 itu ada. Tapi nggak kayak dulu, kalau dulu rame sekali. Sekarang paling dapat jualan ya 100, 120 gitu, 200 ya. Kalau dulu sih ya nyampe dah 1 juta, 1,5 itu nyampe dapat jualan. Bisa sampai 2 juta dulu. Sekarang nggak pernah lagi dapat segitu, sama aja. Belum ada turis ke Bali, masih ya domestik aja.
While Bali has reopened its borders for foreign tourists since October, they're still not coming in. Many international airlines are yet to reinstate their direct flight to the island. Balinese people here really hope they can see more people from Australia, China, and Europe to come visit next year.
I think what we've seen during this period of time is that communicating via video is not a fad. We are using it in all aspects of our lives, for work, for learning, for communicating, for staying in touch.
This is a market that over the past few weeks has made it clear it wants to go higher. It got a little spooked by the idea that geopolitical tensions are rising.
Welcome back to the Open, everyone. 30 minutes into the European trading day, and here are your top stories. The Fed takes aim at inflation. The central bank raises rates by 75 basis points, its biggest hike since 1994, risking an economic slowdown.
I do not expect moves of this size to be common. From the perspective of today, either a 50 basis point or a 75 basis point increase seems most likely at our next meeting.
Supersized relief, stocks snap, a 5-day rout, and yields slide as Powell sues Wall Street, but the post-Fed rally cools. And a tough act to follow. Attention now turns to the Bank of England, which is expected to keep the focus on the inflation fight. We get the S&B decision imminently. In fact, I think we're just getting the S&B decision. Extremely interesting because they've upended the markets, and certainly there was quite a lot of speculation that they were going to raise rates, raising the policy rate by 50 basis points to minus 0.25%. I have to say the markets were pricing in a 25 basis point hike. Again, if you look at inflation in Switzerland, it's not that huge. So they seem to be, first of all, worried about this global tightening policy across the world. And you can see the Swiss franc 102. I also want to bring you, Tom, this is one of the coolest things that we do here on Bloomberg. We have two reporters, Karine and Simon, speaking directly to the S&B right behind me in the bureau here. It's our new Zurich bureau, and they're getting us the headlines. And of course, it's all about how Thomas Jordan, the chair, the president of the S&B, explains this surprise hike, which really no market expectation was expecting them to hike by this much. He's also saying that this could continue. So we'll look exactly at the language from the S&B, and I'll bring it back to you. There you go. That's our newsroom speaking to the S&B right now. We'll get those headlines, and then I'll break them on air for you, Tom.
We talked about the excitement, and there it is. They surprised before, but no one was expecting, as you say, the economists were not expecting a hike. They weren't expecting a hike of 50 basis points from the SNB. So that is significant. Of course, there had been previous concerns outlined, as you know, of course, around the Swissy and the strength of the Swissy. So we'll continue to watch that, which, of course, has moved significantly on the back of this decision by the Swiss National Bank. The importance, then, of that conversation that Francine's going to be having with Thomas Jordan later today. More surprises from central banks. They just keep coming. In terms of the markets here in Europe, you're seeing losses of 1.2% now across the benchmarks. That the relief that we saw yesterday, short-lived. In terms of the bond market, it's just worth flagging to you across the periphery, relative stability today. That's worth flagging. There is some money moving in, or out, I should say, of Treasury stateside. But in terms of the comparisons we've seen in the last few days, you're seeing, I think, around 5 to 9 basis point move across that yield curve. But again, in peripheries, relative calm today on the back of that surprise emergency meeting from the ECB. The DAX is down 1.5%, almost 200 points, and the FTSE 100 down 1.2%. The GBP, the pound, under pressure ahead of that decision by the BOE at midday UK time. Let's switch it over and see how things are looking across these sectors then. Again, as investors readjust now to a Federal Reserve that has reiterated its commitment to getting back to that 2% target of inflation, 75 basis points yesterday, of course, the biggest hike since 1994. It's not going to be common. That is Jay Powell, but he did leave the door open to 50 basis points or 75 basis points at the next meeting. Let's have a look at the sectors then. Again, a move to havens, but across the sectors you're seeing losses. You had seen some initial gains around energy. We know gas prices have spiked on the decision by Gazprom to cut off some supplies to Europe. Germany impacted by that. Red across the screen, every single sector. Retail taking the heaviest hit, down almost 4%. ASOS is a part of that. ASOS really being hit by the cost of living crisis, downgrading their sales forecasts from between 10 to 15% this year to between 4 and 7%. But let's get back to the SNB and Francine, who's been digesting this surprise move by the Swiss National Bank. Francine.
Yeah, so the Swiss National Bank actually unexpectedly raising rates by much more than even the most bullish forecast. They raised rates by 50 basis points, and this is really trying to respond to pickup in inflation. A reminder that this is the first interest rate hike from the SNB since 2007. Officials are worrying that inflation here also in Switzerland could get out of hand, but if you look at the inflation figures, they're well in control. 2.9% is the latest figures that we had. Now, Mr. Jordan, the president of the central bank, really joining the global bandwagon of tightening monetary policy. He hasn't ruled out tightening again. It was interesting, like just for the little story yesterday, I think he got a call from his former professor in saying this is the time not to worry about how high the franc does, but also really to deal with inflation. And again, just a reminder to put in the global context, and our Valerie, Queen of Charts, was reminding everyone, this is just hours after the Fed was pretty aggressive, intensifying its own fight against inflation. It also comes after the ECB also finally acknowledged that inflation was one of their biggest worries. So you wonder whether we are at a tipping point, Tom, where it just puts globally extra pressure on more central banks, and maybe a warning also to economists. There were 20 analysts from the S&P. Only one was expecting a hike, that was Citi, and it was only a move by 25 basis points, whereas actually markets were starting to price in. So again, you have this tension between economists and markets, and once again, the markets were right.
The euro Swissy currently trading at 1.02, the euro lower by 1.4% on the back of this surprise move by the SNB. You're also getting some movement in the bond markets on this as well. Yields up in the periphery. You're seeing the Italian 10-year currently at 388, yields up 6 basis points. When it comes to US Treasuries, an 11 basis point move on the US 2-year, that's at 330 now, and the US 10-year at 337. You're seeing a move there up of around 9 basis points as we continue to digest a surprise move from the Swiss National Bank. Right. Let's get to cryptocurrency space then, because of course this has been a key risk barometer. We're going to outline this for you. One built a massive fortune that rivaled the wealthiest US tech titans. Another amassed a war chest that he vowed would change politics and philanthropy. Some were given a second chance at riches after past ventures flamed out. The cryptocurrency craze turned Zhao Changpeng, Sam Bankman-Fried, Mike Novogratz, and a handful of other digital assets evangelists into billionaires several times over. But just as quickly, they became the new faces of global wealth. They are now seeing fortunes under pressure at a pretty astonishing rate, of course. But joining us now to discuss what's happening in the crypto space is Zhao Changpeng. Zhao Changpeng, thank you for joining us this morning. What do you make of what we've been seeing then in the crypto markets over the last few days, and how aligned it is to the tightening financial conditions we're seeing globally?
I think it's pretty normal for markets to go up and down. It's just normal market fluctuations. We see this in stock markets too. Netflix is down 70-something% as well. So it's just part of a normal market behavior.
But CZ, good morning. I'm in Zurich. You're in Paris. And first of all, I absolutely love your Twitter. I know you have like 6 million followers, but I love the fact that you're always tweeting about Paris and, some of the places that give you extra regulation. There was a bit of a bloodbath, though, in cryptocurrencies, and it's put your rivals in a spot of trouble. Is this an opportunity for Binance? You're hiring. A lot of your rivals are not.
So this is not the first bull cycle that Binance is going through. This will be my personally third bear cycle if we're in a bear cycle. So we have always been quite frugal on spendings during bull markets. I'm not saying spending is bad during bull markets. I think those advertising, those large deals, stadium naming rights, those are great. But we didn't do that. So we always, and also hiring has always been our bottleneck. It's not advertising. We always have a flood of users come. The user demand has always been very high. So we have always been hiring is the bottleneck. So we always reserve cash for hiring. So we continue to do so. And when other companies are doing layoffs, now the talent pool is much larger, and people are much more level-headed in terms of compensations they want, etc. So now is actually the best time to hire. At the same time, now is also the best time to do M&As, mergers and acquisitions. So we're also looking to do that. So in bull markets, raising money is better. Investing is actually very hard because everything is very expensive. But now in a bear market, we see a lot of good deals on the table now.
Okay, Changpeng, let's unpack that a little bit. Let me push you on that. Where are you seeing deals? What do you want to add? What are you looking at?
Well, I can't disclose any specific deals, but there are a number of strong projects that will continue to keep going, and we want to invest in those projects now. Yeah.
What kind of projects, CZ, are you looking at, though? So I know you can't give us specifics, but where are you hiring? Like, where are you seeing the hot trend that will make Binance grow?
I think so. Our approach has always been anything that helps people access crypto. So it doesn't have to be an exchange, doesn't have to be trading. It could be information websites like CoinMarketCap. It could be decentralized wallets like Trust Wallet. It could be other DeFi projects, etc. So also outside of crypto, we're investing in traditional media like the Forbes deal. It changed a little bit, but I believe that's still in discussions. The Twitter deal, I don't know exactly what's happening there, but we're still hoping that will come through. So we're committed to follow through on those deals.
Okay, Chump, are you still committed? Why would you still be committed to Twitter at this point? It doesn't seem like Elon Musk is that committed. You'd put forward $500 million for this.
I think he's leading. We're following. So if he goes through with the deal, we're committed. If he doesn't, then I think we're off.
Would you be disappointed if he didn't go through with it?
A little bit, to be honest. Yeah, we're hoping to be able to contribute to Twitter somehow. Yeah.
Okay, Changpeng, in terms of the broader markets, and I want to get back to what we've seen in terms of Terra USD and in terms of Luna and recently Celsius, do you see this as a healthy washout of some of the frothier parts of arguably an already frothy market and sector?
To be very honest, I wouldn't say healthy washout. We would of course hope that the scale will be much smaller, and we would hope that the damage will be much smaller to do these washouts. But you know, this is how industries work. Sometimes the washouts are pretty significant. So a lot of people did get hurt. So we would have liked to avoid that. But I think, you know, when during a bull market, a lot of people pile in, and a lot of people are here for the short-term money. A lot of people are not very good at managing operational risk, and those guys get washed out during the next bear cycle. So it just happens. So it's not like we want to see it or not want to see it. It just happens.
CZ, talk to us a little bit about, there's a lot of competition in the finance industry, of course, having some global banking partners, so that if you want to open a crypto account with, you know, a constituency or someone that's equivalent, then that helps. How difficult has that been? What jurisdictions have been better at that, and who's your global banking partner?
Sure. So far, it has been relatively difficult for crypto businesses to open bank accounts in most countries. Actually, I think on this point, U.S. is leading. In the U.S., cryptocurrency exchanges can deduct money from the user's bank accounts automatically each month using the SCH protocol. And I think probably only Korea can match that level of automation or integration with traditional banks. But still, it's only limited to a few banks. So the service is not widely available. So we would very much like to see that being expanded. And we are seeing that being expanded in multiple places. In the past 6 months or so, Binance has got licenses in multiple tier 1 jurisdictions. And Binance US also got 4 or 5 new state licenses in the last 6 months. So with those new licenses, that should open access to traditional banking services. Today, it's still quite limited, I would have to say. But I think we're definitely changing for the better.
All right, Cici, thank you so much. As always, great to speak to you, the chief executive there of Binance. Cici, what are you looking most forward to actually in Paris? Because I know you're often in Paris and you love Paris.
Yeah, so well, we now have a French registration for the crypto exchange. So I'm spending a lot more time here, and I also want to help attract more of the crypto industry into Paris. Yeah.
All right, Cici, thank you so much, the chief executive there of Binance. Tom, I'm here in Zurich because we're looking at the S&B. Of course, when it comes to global central banks, this was a really exciting one. I know there was not so much anticipation for an S&B decision, maybe in modern history. Now, they unexpectedly raised interest rates by 50 basis points. Let me tell you, even the markets weren't expecting that, and the markets were expecting some kind of move to be more in line with global inflation expectations, that hawkish move that we've seen across the world. So officials here are basically worried that inflation will get out of hand. We're only at 2.9% currently, and it's extremely clear that by raising a policy rate by 50 basis points to minus 0.25%, they're trying to front-run any kind of pressure from inflation. Now, in a statement, the S&B, Tom, also said that they could not rule out further monetary tightening as central banks around the world act to fight inflation. So first we ask ourselves why were economists wrong? Then we ask ourselves, Tom, of course, why the markets didn't price it in and whether this will accelerate also the global fight against inflation for the ECB, the Bank of England. They're up next, and the Fed.
When you think of cutting-edge technology at sea, you might be thinking of stuff like this. But there's an incoming revolution on the high seas that isn't quite as sexy, but could be significantly more impactful.
Container shipping is the key component of global trade. About 80 or 90% of all the world's goods are transported at sea at some point.
But there's a significant unseen cost to the modern era of global commerce.
About 3% of all the world's CO2 emissions come from shipping.
3% may not sound like a lot, but that's roughly comparable to the entire CO2 output of Germany. Since reducing trade isn't a likely option, what about a technological improvement to help reduce the emissions from these well-stocked maritime behemoths?
Welcome back to the Open, 47 minutes into the European trading day. Volatility has not gone away. You're seeing losses of 1.4% across the benchmark European Stock 600, and the futures, the Nasdaq futures, pointing to losses of more than 2%. Now, the Super Return International, the world's largest private equity and venture capital event, is underway in Berlin. Danny Berger is on the ground. Danny.
Tom, thank you so much. I'm joined now by Johanna Barr, Global Co-Head of Limited Partner Services at Advent. Johanna, thanks so much for joining. So first off, congratulations. You've just closed out your largest fund ever, $25 billion. What does opportunity look like right now to put that money to work?
Well, look, Danny, thank you, first of all, for having me. Look, we're very fortunate to have raised this capital at this point in time. We're very grateful to our investor base for supporting us. And we are, we have a large fund to deploy, but we want to be thoughtful in how we deploy that capital, in particular in these more uncertain times. We have a very broad investment team globally, and we'll look at opportunities bottom up, really thinking through the different sectors, subsectors.
To those uncertain times, what do conversations look like with LPs right now in terms of the strangeness that we're living through?
Look, LPs are asking us, especially at this conference here in Berlin, kind of how are we seeing things? What is inflation affecting our companies? What do we think about the macro? And I think what we need to remind ourselves every day is that we are micro investors at the end of the day. We need to find, for our next fund, 35 companies that are really successful in their sectors and subsectors. And when we diligence for those opportunities, of course the macro impacts our micro decision making, but the micro is really, can the companies, for example, pass on increased costs to their customers?
Can
they thrive? It depends on the company.
Okay.
If you're buying a market leader in a specific sector, absolutely, and you can diligence that. You can figure out, have they been able to pass on those price increases and ultimately continue to maintain their margins. So that's really the thing.
It's interesting because we were talking in the break about how you kind of see the day-to-day of companies, whereas for public companies, you see it quarterly. Are you starting to see any of those signs of stress emerge where perhaps the consumer is spending less and inflation is catching up?
Look, we are. If you ask me about the consumer, I think we will see a hit to consumer confidence. I mean, it's been predicted by macroeconomists and the like. And ultimately, the fully discretionary spend is going to be affected. So the question again is, the companies you own, does that impact your companies? And for the new companies we want to buy, is it a product that the consumer really needs and wants? And that's what we're diligencing.
Yeah, Johan, I do have to ask you, because of course your day-to-day is interacting with investors. I know the SEC had recently proposed some greater transparency with fees, performance for private equity managers. Does the industry need an overhaul when it comes to that?
I think the industry will follow the SEC's lead and take the guidance. Ultimately, it's in our interest to be as transparent as we can, especially vis-a-vis our investors who are deploying their stakeholder and pensioners' money. And so we've always been at the forefront of cooperating with the SEC, cooperating with institutional groups like ILPA, and being very transparent when it comes to our own fee disclosures with ILPA templates and the like. And so I think we always want to make sure that the industry is best in class on those topics as well.
We started this conversation about the record fundraise, and perhaps for better or for worse, one of the natural questions that follow from it is it a peak? Can it be done again?
In terms of kind of fundraising be done, I think yes, we do have a lot of capital that's being raised and been raised in the last 12 months. The asset class has grown a great deal over the last 10 years, but I'm positive. I think it still has room to grow. There might be ebbs and flows in terms of record funds raised, but I think ultimately the asset class has proved that it's been a good returning asset class for investors.
Do you see impact from the sell-off that's happening in public equity increase the attractiveness of private?
It might not. The perverse, in a way, dynamic you have if you have a fall in public equity valuations, actually private equity holdings within CIO's portfolio increases sometimes because the valuations of private companies don't quite immediately follow the mark to market, they lag it. Right. And so oftentimes you then have pressure that the private equity portfolio is actually getting too large in the CIO's portfolios.
Right now.
And that's why it's not a criticism, but it just means that CIOs sort of say, okay, let's slow down our investing on the private equity side to allow to rather rebalancing, if you want, of their own underlying portfolios.
Well, I say criticism. I didn't mean to imply that you were criticizing it, but there have been people, Cliff Asness, he's a quant investor, so looks at public equities, basically saying, look, he called it volatility laundering, but saying that you're just paying to get a leveraged S&P 500 fund that isn't market to market, so it's an illusion of volatility, and basically said that you're tricking investors almost. I mean, is there any validity in that?
Ultimately, investors have to look at the end of their annual 10-year, 50-year investment horizon, what the asset class delivers in terms of return. And private equity has outperformed over many periods the public markets. And ultimately, we can control what we do with our companies over slightly longer periods 5-year hold periods or longer, and can also navigate these uncertainties that we're currently facing with the companies slightly out of the glare of the public eye and quarterly earnings announcements.
All right, Johanna, I'm afraid we're going to have to leave it there. Thank you so much for joining. Francine, Johanna Barr there of Advent.
Thank you so much, Ardeni Berger, of course, at Super Return in Berlin, with some really, really great interviews. Now, we had that surprise hike, Tom, by the S&P just moments ago. It was about 22 minutes ago. Now, we were expecting some kind of course, either talk about inflation or even 25 basis point hike. Only one economist had predicted that, but it was starting to be priced into the money markets, but no one was expecting a 50 basis point hike. Now, this really goes to the angst that we're seeing central banks across the world. I think the Swiss franc shot up about 2% on the back of that. And again, this is what they'll have to balance, is let's, of course, front-run inflation. At the moment, it's at 2.9% here in Switzerland, but let the franc appreciate a little bit more to make sure that they deal with inflation, Tom.
Yeah, and 2.9%, of course, within a global context sounds nothing, but of course they're the idiosyncratic reasons for why it is slightly lower on a global level, but has been edging up. Of course, they revised up their forecast. What is the overlay as well of the Fed action we saw yesterday, and looking ahead to the ECB? We know that they left the door open to 25 basis points in July. Is the SNB now starting to bet that maybe the ECB goes higher on that, maybe 50 basis points in July? What you're seeing across the assets then is a much stronger Swiss franc, of course, on the back of this surprise move. 102 is Euro Swissy, so strength there of around 1.7%. When it comes to the equities in Switzerland, the SMI is now down 2.5%. There's been some movement in the bond markets as well, but Italian BTPs, as our queen of charts, Valerie's been saying, relatively well behaved. Yields up 5 basis points on the Italian 10-year, and yields relatively elevated when it comes to what is happening across the US Treasury curve as well. It is the equity markets where the strain is being felt. Future stateside pointing to losses of around 2%. Francine.
Now, with the last, of course, couple of hours, the leaders of France, Germany, and Italy have arrived by train in Kiev. They are due to hold talks with their Ukraine counterpart, Volodymyr Zelensky. So we'll have plenty more, of course, on that. I think our executive editor, Chad Thomas, will join us shortly to go through that. I don't know if we have pictures, Tom. Do we have pictures of that extremely, extremely important, of course, showing of hands? And it's all about gas, and it's all about Gazprom, and it's all about what we need to do, of course, shortly. Tom, why don't we do a quick market check, and we'll get Chad Thomas set up.
Yeah, absolutely. The geopolitics are fascinating, aren't they? Because these are the three leaders to whom President Zelensky has been arguably more critical, particularly Olaf Scholz of Germany, but also Macron as well, who, of course, caused controversy by suggesting that maybe Ukraine would have to give up some of its territory to get some kind of ceasefire. So we continue to watch the geopolitics. Let's check back in on the markets, though. The primacy is there, absolutely. The Nasdaq futures pointing now to losses of more than 2%. So if things stand, they're going to be wiping out the gains that you saw yesterday for that tech-heavy index. S&P E-mini is pointing lower by 1.8%. The S&B just not wanting to be lost in the mix when it comes to the surprise from these central banks hiking by 50 basis points, Francine.
Yeah, we're joined here by Chad Thomas. Of course, he oversees all of our government coverage. I mean, this is significant. 3 world leaders, 3 European leaders in Kyiv. Is this to show support, but will there be backlash from Russia?
Well, that is what we are watching for, right? And they all have their reasons for going. Scholz has been criticized for not doing enough on the military front. Macron, of course, has made some comments about not wanting to embarrass Russia, which has not gone down well, obviously, in Ukraine. So we'll be watching this very closely. Of course, we had the gas cutoffs from Gazprom in the last couple of days, and so we'll be watching that very closely to see what happens.
Chad, thank you so much. This is Bloomberg.
When you think space, you probably think one space agency that travels under the radar is ESA, which is surprising considering what the European Space Agency has achieved and how vital it is to the global space industry.
We've collaborated with pretty much everybody who is involved in space exploration.
But ESA wants to be a leading force in furthering humanity's mission into space.
Commander Ground, do you copy? Copy.
If we want to have successful human missions to Mars, we are going to have to learn to live and work off-world in a different way. The place where we are going to learn to do that is on the moon.
Can ESA help humanity take its next giant leap?
Bloomberg has enhanced search on the terminal to deliver what you need when you need it. Now, you can simply type phrases in everyday English in the command line. Compare financials. Find people. Analyze markets. You can enter phrases or ask questions. What do you want to know today? Ask a question or visit SearchGo to find answers now.
I think what's clear is central bankers need to catch up to their economies. They've been behind the curve.
There's a chance that we are already in a recession.
It's going to have to go to about 5.5 or 6%.
The one thing that people are not prepared for is interest rates resetting meaningfully higher.
Then if the Fed reverses course, they're going to look like they're weak on inflation. So this is a very, very tough situation that we're maneuvering.
This is Bloomberg Surveillance, Early Edition, with Francine Lacqua.
Good morning, everyone, and welcome to Bloomberg Surveillance Early Edition. I'm Francine Lacqua in Zurich following the S&P decision, and here's what's coming up on today's program. The Fed takes aim at inflation. The central bank raises rates by 75 basis points, its biggest hike since 1994. The S&P follows suit with a surprise 50 basis point hike. We speak later with the former head of the Swiss Central Bank, Philip Hildebrand. The Bank of England up next, and risk sentiment turns sour as recession risk takes primacy of central bank resolve. Stocks and futures deep in the red. So let's get straight to our top story. The Fed moves its bumper move, or it makes its bumper move, hiking 75 basis points, the central bank's biggest rate hike since 1994. Now, the chair, Jay Powell, asserted the Fed's commitment to reining in price pressures, indicating another big move in July.
We're strongly committed to returning inflation to our 2% objective. Inflation has again surprised to the upside. Some indicators of inflation expectations have risen, and projections for inflation this year have been revised up notably. In response to these developments, the committee decided that a larger increase in the target range was warranted at today's meeting. Clearly, today's 75 basis point increase is an unusually large one, and I do not expect moves of this size to be common. From the perspective of today, either a 50 basis point or a 75 basis point increase seems most likely at our next meeting.
Meanwhile, the ECB says it's working on a new tool to curb market stress. It follows an emergency meeting yesterday, convened after Italian yields surged to the highest since Europe's sovereign debt crisis. So for more on all of this, we're joined by Michelle Jamrisco and Bloomberg's Maria Tadeo. Michelle, let's start with you. The Fed delivering its big move. How much more will the Fed need to do?
Well, that is the big question. It always starts right after the meeting. We look to the next meeting. And of course, you heard the Fed chair saying there that 50 or 75 is on the table for the July meeting. I think what was important here is his language around 75 being unusual. Of course, that was a bit of a dovish tilt in that message. But overall, the underlying message was clear. They had to go big. They did go big. They revised their inflation forecasts upward. They revised their growth forecast downward. They acknowledged that it's it's not going to be the sort of soft landing that they had seen previously. We're now looking at rates ending up somewhere in the range of 3.4% at the end of the year, whereas before it was 1.9% as of March. So there it really is a message that they had to go big. They did go big, and we'll see the consequences as we move forward. But now we will be in that debate about how much bigger do we have to go, and what, importantly, what are they looking at? Inflation expectations, core inflation, or something else?
Yeah, Michelle, thanks so much. Maria, of course, the ECB didn't exactly deliver what the markets wanted, but they delivered something, which is, I guess, a little bit less market volatility.
Yes, Francine, absolutely. And I think, I had a contact yesterday who really encapsulated the state of play very well. The ECB yesterday did what it should have done a week ago. The statement, what they promise now openly to create a new tool, although there's a lot of details that we don't know, doesn't give you reasons to sell the market, doesn't give you reasons to buy the market. But for the time being, it has just stabilized BTPs if you look at where they're trading today. I guess for the time being, that is good enough. But Francine, there's a lot of questions in terms of the announcement, the tool. When will it be ready? Will it be the July meeting? Also, what does it mean for the rate hike? And to me, one of the key issues here is the conditionality attached to it, because there is no free lunch. And the idea is that there will be some type of soft, light conditionality around the tool.
Very low. Maria, thanks so much, Maria Tadeo there, and Michelle Jamrisco. Now, we're also watching the Bank of England. It's set to deliver a fifth straight rate hike today, with officials expected to stick to a steady path amid global chaos. Now, here in Switzerland, the SNB also just delivered a surprise hike of 50 basis points, and the governor, Thomas Jordan, says the central bank will consider currency sales if the franc weakens. Well, amid all of the movement from central banks, the positive sentiment in stocks overnight has evaporated as recession fears seep into the markets. Now, futures in the U.S. and stocks in Europe are now deep in the red, and the rise in yields has continued. Now, with us is David Cole. He's chief economist at Julius Baer. David, great to have you on the program. Look at this beautiful office. We're just inaugurating, and I'm happy we're inaugurating with you our new Zurich office. I mean, the S&P was really a surprise. Does it really go to the angst of every central bank? Inflation in Switzerland is not that high, 2.6%, but they worry that actually, because of this global tightening cycle, they get stuck out.
Well, I would rather see it as an opportunity, and the SNB was brave enough to use this opportunity to normalize. And we have, of course, inflation globally is high. That's probably the starting point for every central bank right now to normalize. Although you said it, in Switzerland it's like 2.9%. That's nothing against like this 8%. We think other moves or other things are much more important for this SNB. And the first one is what we heard from the ECB. They do something against fragmentation, and that's in particularly puts away pressure from the Swiss franc. So it opened really this huge opportunity for the Swiss National Bank to go to more normal rates. And the Swiss National Bank is worried actually about these deeply negative rates, the excesses which are happening on the real estate markets, on the credit aggregates, and
David,
so on.
What will happen to the franc, the Swiss franc, from here?
Well, so far it digested that very well in terms of, the SNB is always worried about too much strength at the Swiss franc. This is less of a fear right now. In an environment where you have to worry about inflation, a strong currency is a good thing. Yeah? In particular, when inflation is coming from outside, when it's imported, a strong currency helps really to cushion this effect on the domestic side, and this is exactly what we're seeing for the S&P.
David, I mean, overall, I feel like the S&P. First of all, where were the economists on this? Like, why did no one predict this were happening? And is it going to put a lot more pressure on central banks around the world? Is this the first moment where we say, wow, if the S&P hikes by 50% and no one was expecting it? I mean, I think one economist was expecting 25 basis point hikes. It means there's a real inflationary problem.
That was really the big surprise, and we wonder why the SNB or officials of the SNB did not signal that to markets. I mean, that seems to be like that central banks are really wanting to.
Well, the markets were expecting it more than economists. Like, what's going on?
It seems like that central banks are really erased all this put call for financial markets, so they don't want to support financial markets. They want actually more volatility, simply probably to address also these problems of misallocation of capital. We're coming out of a time of very cheap money, so what follows is always some kind of misallocation of capital. We've seen that less in Switzerland, actually, but really this is a big surprise. Not why the SNB hiked rates, but rather why they had not signaled that beforehand. I think still the S&B has all the time not to hike rates really to a very strong level, but rather normalize interest rates.
Do you think it was because of the Fed? So my executive editor sent me here, and he was like, the S&B is the most important decision this week. And I was like, really? Actually, will this turn out to be a pivotal point in when we realize that inflation is a real problem across the world?
Well, again, inflation is not a problem in Switzerland. Yeah, so,
but it could be. They're preempting. They're front-running.
I wouldn't say so. So first of all, you have really this strong currency, which helps to cushion the imported prices. So this helps definitely in Switzerland. And then you don't have the same excess demand problem in Switzerland like you have at extreme, really, in the US. A little bit in the Eurozone, not as much, and none in Japan, which is another central bank which is apparently not acting. Yeah.
David, overall, I mean, when you look at the Fed, interest rates in the US, interest rates in Europe, I mean, where do we end up? Is 5% something that we need? I mean, if we have inflation at 10% in the US, we're going to have interest rates at 5% to deal with that.
Well, listen, we think that what the Fed is doing right now, it's highly appropriate. Go 75 basis points in June, go 75 basis points in July. That's highly appropriate at the current situation. But look at the projections of inflation for next year. It's 2.5%. For 2024, it's 2.5%. So why really go in all this tightening path? And the projections for the appropriate level of interest rates, it's 3.8% for end of next year. This is too high according to our read. We think when inflation comes down, the Fed will proclaim victory and really will relax the pressure to hike rates to that aggressive rates. You mentioned 5%. We don't buy into that.
Okay, so what's the top terminal rate?
Well, terminal rate is also according to the Fed 2.5%. This is their long-term projections, which they didn't change. Which they didn't change much. We think it will be probably between 2 and 3%, and we don't see reason really to hike rates above the 3% level beyond 2023. We think this year it's highly appropriate with the demand push. Next year, not.
David, thank you so much. David Kohler, Chief Economist at Julius Baer, joining me here in Zurich. Now, coming up, the Bank of England is set to deliver a 5th consecutive rate hike today, with officials expecting to stick to a steady path amid global chaos. More on that next. This is Bloomberg.
Stories about what they call black soot caused by the manufacturing and consumption of these fuel products in the illegal refineries.
Oil theft, known as bunkering, and the refining of its spoils is worsening the damage from decades of fossil fuel exploitation, creating one of the world's most severe ecological disasters.
Our sacred forests, our homes have to give way to oil wells, and no one gets much benefit.
Imagine a resident of Port Harcourt who inhales this soot every second in 24 hours, 7 days a week, 30 days in the month, and for years now, we are dying slowly but surely, and our lifespan is reducing every day.
Access the financial world on demand. Hear from leading economists, policymakers, and industry experts via live and on-demand webinars, only from Bloomberg. Start exploring to see what's moving the markets. Visit Bloomberg.com/webinars.
Economics, finance, politics. This is Bloomberg Surveillance Early Edition. I'm Francine Lacqua here in Zurich. Now, in London, the Bank of England set to deliver its fifth consecutive rate hike today, with officials expected to stick to a steady path. The decision comes against the backdrop of a global rout in financial markets and soaring inflation. Well, joining us now is Bloomberg's Lizzie Burden, who's outside the Bank of England. So, Lizzie, how will the BOE balance the recent UK economic data? It was good for the doves, and it was good for the hawks.
Well, Francine, we're not expecting the fireworks that we've seen from the ECB or the Fed. Of course, those decisions, it'll be too late to impact what happens on Threadneedle Street because the vote's already done. But they do have this difficult balancing act. It's between 25 and 50 basis points here. On the one hand, for the hawks, you've got CPI running at 9% in the UK. It's swallowing up wage growth. And since the last decision, we've had another £15 billion of fiscal support from the Chancellor, Rishi Sunak. Even he says that's going to be inflationary, even if it boosts growth. But on the other side of the ledger for the doves, the economy unexpectedly contracted in April. You've got consumer confidence down, the housing market's starting to slow, and you're seeing some of that tightness coming out of the labour market. So it's a recession in all but name here in the UK, and that's why our economists are expecting a cautious rate hike of 25 basis points, taking the key rate to 1.25%, and it'd be unprecedented in the bank's history to have 5 straight rate hikes.
Lizzie, thanks so much. Lizzie Burden there outside the Bank of England for us. Now, joining us now is Mel Stride, MP. He's UK Treasury Committee Chairman. Of course, the UK Treasury Committee has warned the government against unduly weakening financial regulation, with a panel of lawmakers even saying that the Treasury should not forget the lessons of the financial crisis. I am delighted to be joined by Mr. Stride, MP, Chairman of the UK Treasury Committee. Thank you so much, Mr. Stride, for coming in. When you look at some of the warnings that you've told government, have you seen some of the watering down of regulation that you worry about already being talked about or even put in place?
Not at this stage, because what's happened as we left the EU is that all these regulations have been brought into UK legislation, and they're going to then move down into the regulators, some of which, of course, those regulations will be amended in that process. So it's an ongoing process. I think we've seen some signs of actually quite positive change that may be afoot, particularly around something called Solvency II, which relates to the insurance sector and could have a very positive impact in increasing and improving their competitiveness and also levels of long-term investment in the UK. But there is a risk, as you said there, that this may be a time that government chooses to loosen up on regulation too much, and we mustn't forget the lessons of the financial crisis of 2008.
What particularly actually are you worried about? So if this is a preemptive warning to the government, is there something that they might do that really worries you?
So there's a lot of debate about what the objectives should be of our regulators, and there's been some talk that there should be a primary objective for both the FCA and the PRA here in the UK around competitiveness. In other words, putting competitive advantage above prudence. And I think the committee feels that that could be a mistake, albeit that we think there is more scope now to have a secondary objective for both of those regulators around long-term economic growth. So there are opportunities here, but there are also risks if the government moves too far and too fast in terms of loosening regulation.
What kind, Mr. Stride, of moves should the FCA or PRA do to try and achieve some of the secondary objective to promote long-term, of course, economic growth, but also financial inclusion?
Okay, so basically it's a case of a case-by-case basis where they look at regulation, and there'll be thousands of different files of regulation that they're going to be looking at now over what will be several years. And it's really just a case of looking at each and every one of those and where changes are being considered to do that, not just in terms of their primary objectives, but also looking at how growth could be encouraged. Now, I mentioned Solvency II changes, for example. Without getting into all the technicalities of that, that's a good example, because if there are certain changes made there that don't weaken the financial resilience in that area, but do encourage greater investment in long-term things like infrastructure in the UK, then that could be a very positive move. So it's that kind of balancing act that's important here.
I mean, I was struck by the fact that there's been, you know, after the market meltdown, a lot of talk about or reminiscing or thoughts that this could replicate 2008. do you see currently the financial system strong enough liquidity on the markets to avoid some kind of financial meltdown?
Certainly from the UK's point of view, when we've had the Bank of England before the committee and the Governor of the Bank of England and the Monetary Policy Committee, the question of resilience, I think the answer is that our financial system is very resilient. It's subjected to very stringent stress tests on a relatively regular basis. So I think the banks are well capitalised and in good shape. So I don't have any concerns on that front at this stage.
Do you have confidence in the Bank of England and the Governor, Andrew Bailey, to fight inflation?
Yes, I do, but that's caveated. So I think that the spike in inflation that we're seeing at the moment, which is going to rise here to over 10% in the autumn, is obviously a cause for great concern when the bank's target is just 2%. A lot of that spike is, to be fair, I think outside of the Bank of England's control when it comes to monetary policy. The bank cannot control the price of oil. It can't stop wars occurring between Russia and the Ukraine, or supply chain bottlenecks or lockdowns in China. A lot of the stuff that's external to the economy that's causing the inflationary pressure. But where I think it has been flat-footed is in the labour market, where we've ended up with a very overheated labour market, and we've also allowed inflationary expectations to run away with themselves. And I think there are some dangers here in the UK of a wage price spiral, with wages increasing prices, pushing up wages in turn. And I think the bank has probably been rather slow to react there. And the cost of that, of course, will be that they'll have to do even more on the monetary policy tightening side in order to bring everything back under control.
But overall, in the appearances of the governor, you've been reassured, I guess, by his presence. I know there's, he's come under fire for certain comments about apocalyptic, food prices, for example, or even the fact that you shouldn't ask for a wage hike so that inflation is under control.
Yeah, he sometimes chooses his words slightly clumsily. I think that's fair to say, and gets a difficult headline as a consequence. But look, you can't get away from the fact that there have been an extraordinary number of crises that have hit the world economy, the UK economy, not least the virus, of course, as well as all the other things that I've just mentioned. And it would be remarkable, I think, if any central bank or central bank governor had just glided through all that with fingertip control of every aspect of it. So I think we recognise the extraordinary challenges that he's faced. I think he's a steady hand at the tiller. He's got a lot more work to do, but the committee certainly has a very high level of confidence in the Bank of England and its governor.
Mr. Stride, do you think the Chancellor has to come back with an energy package, soon, if prices continue rising at these levels?
Okay, so that would be in terms of relieving the cost of living pressures that are going to hit a lot of people in the UK over the coming months. Now, he's brought in a package of 15 billion, which really will make a big difference. It's particularly targeted at those that are poorer households, where a disproportionate amount of their spending is on energy itself. So that's really important. I think the question really is, where do energy prices go over the coming months? And of course, they've been very volatile, and it is possible that maybe the conflict between Ukraine and Russia settles down or is resolved in some form over the coming months. And these are all things that are difficult to predict at the moment. Also in the UK here, once we get to April of next year, all the benefits here will be uprated by the inflation figure as it will be in September this year, which will mean a very significant real terms increase in benefits from April of next year. So the question really is, between now and April, does he have to do more? He'll want to wait and see what happens, I think.
Mel Stride, thank you so much for joining us today. Mel Stride, MP, they're chairman of the UK Treasury Committee. Now, coming up, we speak with Jeff Curry, Goldman Sachs Global Head of Commodities Research. He joins us to discuss all things energy and commodities. That conversation at 9:30 a.m. UK time, and this is Bloomberg.
Delhi airport, and behind me you can see SpiceJet 737 MAX aircraft. Earlier today said that Boeing is going to compensate SpiceJet in form of cash and aircraft. There's a big celebration happening at the Gwalior airport. As you can see, they've literally rolled down the red carpet for SpiceJet chairman Ajay Singh. There are balloons, there are flowers. This is a big deal for SpiceJet because it is the only Indian operator of Boeing 737 MAX planes currently.
It's really a reminder, isn't it, just how sensitive the markets are to any commentary about trade. We did see some pressure on the yuan, we did see some pressure on the futures. That is now being reversed.
Economics, finance, politics. This is Bloomberg Surveillance Early Edition. I'm Francine Lacqua here in Zurich. Now, we're just getting quite a lot of movement when it comes to Swiss franc overall. Now, it's not just the Swiss National Bank taking the markets by surprise and hiking by 0.5 percentage points. I guess what's also concerning Swiss franc traders is that officials are no longer that troubled with the currency's strength, which opens, of course, the way for further Swiss appreciation. One way of looking at it could be Euro-Swissy, given also the pressures it puts on the European Central Bank and its patient stance amid the challenging environment. The other way would be to look at Swiss yen. Now, viewer from Mitsuho writes in, the Swiss franc is surging post the shock and SNB move, a classic market surprise. We'll have plenty more, of course, on some of these central bank action. Coming up next, the one and only Jeff Curry on commodities. This is Bloomberg.
When you think space, you probably think one space agency that travels under the radar is ESA, which is surprising considering what the European Space Agency has achieved and how vital it is to the global space industry.
We've collaborated with pretty much everybody who is involved in space exploration.
ESA wants to be a leading force in furthering humanity's mission into space.
Commander Ground, do you copy? Copy.
If we want to have successful human missions to Mars, we are going to have to learn to live and work off-world in a different way. The place where we are going to learn to do that is on the moon.
Can ESA help humanity take its next giant leap?
Mercedes-Benz is on a path towards CO2 neutral mobility. So we have flicked the switch there, and really we're going to step by step electrify everything. And what does that mean? Combustion engines get electrified.
However you get your news.
This is Bloomberg Daybreak with Lee.
On Bloomberg Radio.
Welcome to Daybreak Australia. This is Bloomberg Technology. This is Bloomberg Green.
On TV, radio, and the web, this is Bloomberg.
The Fed takes aim at inflation. The central bank raises rates by 75 basis points, its biggest hike since 1994. The S&P follows suit with a surprise 50 basis point hike. We speak later with the former head of the Swiss central bank, Philip Hildebrand. The Bank of England is next, and risk sentiment turns sour as recession fears become the focus of central bank resolve, while stocks and futures are deep in the red. Well, good morning, everyone, and welcome to Bloomberg Surveillance Early Edition. I'm Francine Lacroix here in Zurich. Now, crude oil up more than 50% this year due to upended trade flows after Russia's invasion of Ukraine, and it's only edging higher as traders weigh central bank action and rising U.S. output. Now, the International Energy Agency said on Wednesday that global supply will struggle to meet rising demand in 2023. Well, joining us now is one and only Jeff Curry. He's global head of commodities at Goldman Sachs. First of all, Jeff, good morning. Thank you for joining us on yet another big energy and oil day. Is this much worse than you thought?
Yeah, absolutely. The markets move faster, and the fundamental tightness is deeper than what we would have thought 3 or 6 months ago. And I want to emphasize to everyone that this is not entirely a function of the war. These trends were put in place going back a decade ago. You know, the term we used is the revenge of the old economy. And it's not just in oil and gas, it's metals and mining, it's agriculture, it's the entire old economy space. In fact, I would argue it's anything capital heavy. We've ignored capital heavy in favor of capital light for the last decade. And this is what we're ultimately with severe shortages, you know, across some of these really key markets that were exacerbated by the Russian invasion of Ukraine. So, you know, this is where we should be, but it's a lot deeper than what we would have initially thought.
So, Jeff, is it going to get actually a lot worse? What kind of prices can we see?
I think, you know, the upside, particularly in energy and food right now, as we go into the summer months, is severely skewed to the upside. Why am I going to argue that? One, particularly in the context of China, everybody's waiting for the recession. From a commodity perspective, we were in a recession in April and May. Metals demand contracted by 10%, oil demand contracted by 2.5% globally. Those are recession-like numbers. Well, it looks like we're on the backside of China as they come out of lockdowns. And, you know, I'm not going to say there's a green light, but the acceleration basing, demand out of China between now and the summer months, particularly given the fact that the stimulus that they're putting in the system is the third largest since the financial crisis. So one, China. Two, Russia, the sanctions are likely to start to bite more deeply as we go into year end. We'll see if they actually implement them, but it's going to tighten it from the supply side. Then let's not forget, people haven't been on holiday for 2.5, 3 years, that the travel season this summer is likely to be, it already is, you know, a record level in terms of just looking at airline tickets.
Jeff,
so, you know, the upside
but when you look also at oil, I mean, refining is without a doubt one of the biggest, if not the biggest problem in the oil markets right now. So how will that pan out? Is there any side to the capacity crunch?
Well, when we think about where the shortage is coming out of Russia, it's in the refined product side, more so than it is in the crude side, because they essentially have taken those refineries off the global market. Now, when we think about the ability to bring on refining capacity, that takes decades, and there's nobody who's actually built a new refinery in the West since 1977, which is an indication growing the supply here is not something that's very, very easy. You know, you look at the Chinese and you look at the Russians, that's where most of that spare capacity exists in the world right now. So when we, you know, look at the policies being implemented in the U.S. or talked about in the U.S. right now, you know, about responding to the record margins, let's remind, this is a global problem. It's not a local problem in some place like the U.S. And the ability for the U.S. to unilaterally fix this problem is severely constrained.
So, Jeff, does it mean that actually product price will be much more elevated than crude for, what, the next 5 years? Can it be longer? Like, what's worst case scenario?
Well, we think you're going to see some normalization in the product cracks as we go in this year, as refineries come out of turnaround. and you debottleneck some of these refineries, because they can debottleneck them, put investments into the existing refinery to make it process more crude and produce more product. But it's, to give you an idea, historically, you just take a gasoline crack, it trades 20-25% of the crude price. Recently, it's been 45-50. So let's say we get a normalization down into that, 30 to 40 range. You kind of get the idea. It's not all the way back, but it's not nearly as high as what we're talking about right now. So, but I think the key point here is it gives us the revenge of the old economy. Underinvestment in refineries, underinvestment in oil production capacity, trucking problems, shipping problems. I can keep on going down the list. Copper mines. Basically, we favored short cycle iPhones over copper mines for the last decade, and this is the shortages we're ending up with.
So, Jeff, there's very tight supply, or the supply-demand dynamics are going to be very tight for 2023. What happens after that? And what happens to your forecast if we actually get a global slowdown?
Well, the global slowdown, let's say it's Fed-induced. I want to emphasize demand destruction or demand slowdowns is not a fix to this problem. It may be a temporary solution and it may create a pullback in prices, but it's not a long-term fix. There is only one long-term fix to this problem, and that is investment, harnessing large amounts of capital into this space to debottleneck it. I don't care if it's growing supply through actual investment in production capacity or it's through productivity gains and technology. Both avenues require investment. And at this point in the game, we still don't see large-scale investment. We see outflows in commodities. The equities are trading with free cash flow yields of 25-30%, record free cash flow yields across the entire old economy. And then you look at credit spreads, they're widening in a $120 environment. So the net of this is telling you we're still not seeing the capital flows. Now, what are the reasons for the lack of investment? Number one is a history of bad returns. Most people are pretty scarred by the experiences of the last decade, so no wonder there was no capital. Number two, the volatility is too high, that scares people away. And then number three is ESG.
Yeah, right. And Jeff, I wonder whether then at this point we'll see any more CapEx given also the transition. But are you expecting more oil from OPEC Plus once President Biden meets with the Saudis?
Well, let's just go over, potential spare capacity, somewhere a little bit north of 2 million barrels per day between Saudi Arabia and UAE. We look at the loss in, let's say Chinese demand is down somewhere around 800,000 barrels per day. It rebounds. Seasonal uptick in demand is 3 to 4 million barrels per day. The potential right now, Russian supplies are down about 600,000 barrels per day, likely to be down 1.5 million barrels per day at year end if the sanctions are imposed. So the net of that is a lot more than 2 million barrels per day of required, just call it call on OPEC or, supplies more broadly. So, and also let's remember, there's 1 million barrels per day potentially coming out of the SPR right now, and that starts to run out relatively soon. So you really ought to ask, where is this supply going to come from? And let's not forget, you have shortages in grains, shortages in gas, and then they siphon off one another. What was the immediate fix to the gasoline problem in America? Take from the corn supply, move ethanol in. Eventually, we're going to have, really serious shortages.
But it's always a timeline problem, isn't it, Jeff?
Yeah, absolutely. I just want to say, longer term, we need to get capital. And when Volcker took interest rates up, the 20% in 1979, it was off the back of 6 years of CapEx. We don't have that CapEx right now. So the terms of thinking about how long it's going to take to fix this problem. Here's another important point. Don't expect that the interest rates can come back down. You basically need to have a situation in which not only are you slowing demand growth with the higher rates, but you're then saying, hey, world, don't invest in things that are all short cycle. Going back to my iPhone versus copper mines, you end up going to have to move more capital into oil production, copper mines, and all of these capital heavy entities.
All right, Jeff, thank you so much. Jeff Currie, all fired up there, global head of commodities at Goldman Sachs. I want to also get back to Jeff and ask him about Exxon and the comment we heard from President Biden on Exxon making more money than God. Coming up, big and bold moves from the world's leading central bankers as they feel the pressure to tackle surging inflation. More on the Fed and the ECB next. This is Bloomberg.
the basic law of economics.
It validated what the market was already pricing.
Need to catch up?
This is Bloomberg Wall Street Week. I'm David Weston.
We've got the information and insights.
David, you just hit the nail right on the head.
From businesses most influential and instrumental.
And that's the way you run good risk management.
It's a challenging dynamic. We could continue to see that kind of strength.
Bloomberg Wall Street Week premieres Friday with replays all weekend on Bloomberg Television and Radio.
BSO Now is your online home for weekly Boston Symphony Orchestra and Boston Pops performances. See new concerts that go behind the scenes, plus acclaimed archival concerts. Visit bso.org/now, where the music plays on. BSO season sponsor, Bank of America.
Economics, finance, politics. This is Bloomberg Surveillance Early Edition. I'm Francine Lacqua here in Zurich. Now, we had a pretty exciting S&B. I have to say there was a lot of market expectations on what they do, but despite the market expectation, they still surprised a 50 basis point hike. Now, central banks had one of the most significant days and weeks in recent history yesterday. The Fed hiked rates by 75 basis points, the biggest hike since 1994. The ECB held an emergency meeting and set about creating a new tool to curb market stress. That's after Italian yields surged to the highest since Europe's sovereign debt crisis. Now, just over an hour ago, the Swiss National Bank also unexpectedly increased interest rates by 50 basis points for the first time since 2007. Officials responding to a pickup in inflation that they fear can actually get out of hand. Now, on the back of the news, the Swiss franc surging 2%. With us, the BlackRock Vice Chair, he is Philip Hildebrand. He's one of the greatest minds when it comes to inflation. He's also former S&P president. So, Phil, you're like Phil. I've never called you Phil before, but you're like the dream guest when it comes to inflation.
Good morning, Francine. It's great to be here.
Philip Hildebrand, you've always come on and said, look, we shouldn't worry too much about inflation because it's a supply shock and actually it will kind of readjust. The markets now seem to say, look, they got it wrong. They should have acted quicker. Have you readjusted your inflation expectations?
No, I think the key is that we live in a world shaped by supply. You know, in the past, it's always been about demand. This is a different world. The great moderation is over. And what it means for central banks, principally, I think, is that you can no longer automatically stabilize both inflation and output. There's a trade-off involved here. That's the effect of having the world shaped by supply forces, and this is what's been driving this inflation. So what we have to understand, and markets are coming to terms with this, is that the more aggressive you focus on inflation, the more you're going to have output volatility and stress in financial markets. The days of kind of the divine coincidence when if you stabilize inflation, you would also automatically stabilize output, those days are over.
So are you telling me that the Fed cannot engineer a soft landing?
I think it's very unlikely, exactly. I mean, this is the key, and in my mind, what's been missing a bit from the communication framework of most central banks is to acknowledge that we're no longer in the great moderation period. This is a different era, a different regime, and there's a trade-off involved. And you have to start to talk about this and say, yes, we can aggressively raise interest rates. Yes, eventually we could get inflation down, but it comes at a cost. There's a trade-off involved in terms of output and in terms of, as we're seeing, financial markets.
So do you believe that the Fed is now maybe too aggressive? Are they right to be as aggressive to actually try and deal with inflation, or will it push the U.S. in a recession?
I still think there are two topics here. One is, should we get out of this very expansionary monetary policy? Absolutely. That's why I think what we saw this morning across the street here makes perfect sense. We need to get to normalizing rates, right? And as quickly as possible, frankly, in my mind. Beyond that, it's a whole different story. That will not be enough to get inflation anywhere near the levels we had before. And so then comes the question, what do? Do you really go into very tight territory? Do you aggressively tighten monetary policy to get inflation down? You'd have to tighten it, I think, very aggressively to do that, given the supply side nature of inflation. And that's when you have to start to acknowledge that there are trade-offs.
Let's focus on the Fed, because I do want to also really speak about the S&B with you at length. But on the Fed, what's the terminal rate? So if inflation's at 10% and gets stuck around that level, are we going to see interest rates at 5% or beyond?
First of all, I believe inflation is peaking as we speak. And so we will start to see inflation coming down. And it's going to be lower in 6 months, but it will still be much higher than what we're used to. And that's when the issue comes.
Levels?
No, it'll be significantly lower than where we are today, but it'll be far away from 2-3% or whatever the target might be in different countries. So, and that's when when the issue comes up. My sense is that in the end, because of these trade-offs that I talked about, we will end up seeing cumulatively less interest rate hikes than what many people are thinking right now. Because the cost of it in terms of output, in terms of market volatility, will simply be too high.
I was going to ask you about market volatility. Do you worry about liquidity?
Well, liquidity is going to be an important point, certainly. I mean, in this world where we're no longer in the great moderation, where there is a trade-off, there will be great volatility. You can't just stabilize everything just by stabilizing inflation. That means market participants have to brace themselves for volatile markets. We're seeing it again this morning. And that means, of course, as a market participant, you have to focus on liquidity, because what you don't want to do is get caught up in a volatile, uncertain market with limited liquidity. So I think the focus on liquidity will be very much a dominant theme amongst market participants.
But is that something ugly could happen? What did we live through on Monday? I mean, some traders were almost making parallels with 2008. Now, I know it's very different in nature, but it was, a pretty big wake-up call.
Yeah, because this is very different than 2008. The financial crisis was a huge shock, but it was a classic demand shock. What we're seeing here, this is an economy shaped by supply. And so therefore, the reaction to tightening will be very different. And that's what markets have to embrace.
What you're telling me is that then all bets are off because we've never seen this before.
That's right. I think this is, this is an entirely new regime. The great moderation that Ben Bernanke and others coined beautifully at the time, that period is over. It's behind us. And frankly, central banking is much more difficult today than it was for my generation.
So this means what? That we could have a further correction, even a 10% correction across the board of all asset classes once markets realize this dynamic?
If the central banks were to choose to really drive inflation back to the targets, they would have to raise rates very, very aggressively and would not be able to stabilize output at the same time. And so until they clarify this trade-off story and where they see themselves with regard to this trade-off, I think markets will remain vulnerable.
Is S&B symptomatic of that? Is it a wake-up call? Because inflation in this country, in Switzerland, is only at 2.9%. So the fact that they surprised the markets, that I think one economist out of 20 was expecting a 25 basis point hike, and yet they hiked 50%, symptomatic of the fear among central banks.
I don't want to get into the tactics of what was done here, but certainly normalizing makes perfect sense for the Swiss National Bank, as it does for all central banks, frankly. We're in this restart dynamic. We don't need rates where they are currently. So there's no question in my mind that they should all normalize relatively quickly. The issue is what comes beyond that. At the moment, the rhetoric, particularly from the Federal Reserve, is very much focused. We're going to break this inflation as if it were a normal cycle. In my mind, what will be required in the weeks to come is start to talk about this reality of the trade-off, that you can no longer automatically stabilize output if you stabilize inflation. And there's going to be a significant cost factor involved here.
So go to cash.
Gold. I'm not sure, but I think what we need as investors, we need guidance from the central banks as to how they see the reality of a world shaped by supply that means you're going to have trade-offs.
Philip Hildebrand, thank you so much. The Vice Chair of BlackRock stays with us, and we'll talk a little bit more about the Swiss dynamics and, of course, some of the talk about parity with the euro, or whether all is to play between Swiss and yen. Now, the Bank of England also set to deliver a fifth consecutive rate hike today. We'll have coverage on this throughout the day, but more with BlackRock's Philip Hildebrand is next. This is Bloomberg.
companies now, they're getting hundreds, maybe even thousands of applications. So software has come in to automate the process.
You want to write your resume for robots, not for humans. The only job your resume has is to be comprehensible to the software that is reading it, because that software or robot is going to decide whether or not a human ever gets their eyes on it.
These things are programmed by a certain segment of the population that might not be totally inclusive or not be fully aware.
Concerns about how this technology could exacerbate discrimination. For the FTC, I think foremost, the FTC needs to be making sure that we're fully understanding this technology.
We don't trust companies to self-regulate when it comes to pollution. We don't trust them to self-regulate when it comes to workplace comp. Why on earth would we trust them to self-regulate AI?
Front Row, exclusive interviews with the most influential figures in finance. Lloyd Blankfein.
Deflation is a terrible thing. Inflation you could tolerate.
Kathy Wood.
Tesla will be in the pole position to dominate.
Jeremy Grantham.
We've had a very, very abnormal honeymoon Goldilocks period.
First available on the Bloomberg Terminal, then on Bloomberg Television and Bloomberg.com. Front Row, the best seats in the house for business's greatest minds.
This is a market that over the past few weeks has made it clear it wants to go higher. It got a little spooked by the idea that geopolitical tensions are rising.
Economics, finance, politics. This is Bloomberg Surveillance Early Edition. I'm Francine Lacqua here in Zurich. Now, we're talking about the S&B. I'm here, of course, covering the decision. I was told this is the most exciting S&B decision in modern history. And I have to say, I was not disappointed. They surprised and hiked by 50 basis points. Let's get back to Philip Hildebrand, Vice Chair of BlackRock in a former life, of course, also President of the S&B. What do you do with the currency? I mean, what if you look at Switzerland, so I guess this is one of this idiosyncratic things where a little bit of a higher Swiss franc is not something to be snubbed at given the inflationary pressures.
Yeah, I think at the moment Switzerland is in a relatively comfortable position with regard to inflation. Monetary conditions because of the currency are tighter than elsewhere. And, you know, that's on balance, I'm sure, a welcome development from the perspective of the Swiss National Bank. Nonetheless, monetary policy ought to be normalized, and so I think today's decision is perfectly sensible. There was a window that opened up, and you know, we don't know how long these windows will last, right? This is my point about the trade-off, and so I can see why they did what they did.
And then yesterday we had the ECB. I mean, this is when your expertise really comes in play. It's all of these, you know, interdynamics between the central banks and what markets will do. Where are we seeing, or where will we see the biggest dislocation? If we look at fragmentation, the fact that ECB addressed it but vaguely, is the market continuing to test that?
I think what these cracks in the market, whether it's the peripheral story in Europe, whether it's equity markets or the yield control issues in Japan, you know, all of this shows the cracks are beginning to appear, which in my mind is exactly underpinning what I said earlier, that we are no longer in the great moderation. You can't just assume that by stabilizing inflation, everything else will stabilize. This is a very different world from the last 40 years. And as you do that, you start to have a cost as a trade-off involved. And I think what we're seeing, what we saw yesterday, is a perfect manifestation of that. And of course, you know, central banks need to start to talk about this and acknowledge it and take it into account in the decision making.
Why are markets not seeing this?
Well, I think they are seeing it. In a sense, they're reflecting it through these cracks that are appearing in markets. You know, and what hasn't happened yet is that the central banks haven't framed their communication, in my mind, based on this new world shaped by supply and based on the fact that there will be significant trade-offs as you focus on inflation here. And at the moment, all central banks are almost in a, and I understand this, given the politics of it, in a kind of frenzy to prove to the world that they're going to get inflation down. That's fine, but they need to acknowledge that unlike in the past decades, this comes now at a significant cost to output and to market volatility.
But, you know, again, once they crystallize that, the markets latch onto that, and we start pricing in maybe the risk of a recession. What do markets look like?
Well, if they come to the conclusion that central banks will ignore this trade-off and aggressively tighten up to the point where you can essentially crush demand in order to get realigned supply and demand, I think we're going to see more of the market attention we're seeing. The alternative is that at some point, which is, I believe is likely, the central banks will have to acknowledge that the trade-off is very significant, the cost is very high, and they'll end up having to tolerate somewhat higher inflation for some time in order to manage this complicated trade-off story.
Philip, thank you so much. Philip Hildebrand there, Vice Chair at BlackRock. Now, we'll have plenty more, of course, on the markets throughout the day. Bloomberg Surveillance Early Edition continues in the next hour. Matt Miller, Kriti Gupta in New York, Anna Edwards in London. The focus firmly, of course, on central banks. The focus firmly on how these central banks deal with inflation without going into a recessionary environment. Philip Hildebrand, once again, focusing on the supply side of things. And then I'll have plenty more, of course, on the S&P throughout the day. This is Bloomberg.
Estudio, nuestro experimento, no hemos pintado todos los edificios de blanco, sino estos más asequibles de pintar. Y ya hemos detectado reducciones medias en el área metropolitana de 0,8 grados aproximadamente en un periodo de ola de calor y con picos máximos de 4 grados de disminución en un momento puntual del día, en una zona puntual del día. Y como dices, en una ciudad como Barcelona funciona incluso mejor que las zonas verdes, según las modificaciones nos detectan incrementos, o sea, disminuciones de temperaturas mayores con tejados blancos que con incrementos de zonas verdes como tienen planteados el plan director urbanístico.
Stocked early enough all these precious materials you were just mentioning, and we were on the lucky side that our prognosis was spot on in a way, forecasting what kind of material we would need and what quantity we would need.
I think that it's hard to put your head around any narrative. Let's just be honest. We've had sort of a shift in, are we in some sort of stagflation fears moment? People were talking about that all day yesterday.
A big change from the Fed.
The Fed definitely caught up with the market pricing of rate hikes for the next couple of years.
I think the Fed really needs to send the message that it is going to crush inflation and do it as fast as possible.
They said they're going to move expeditiously, and they've kind of stuck to their word.
I don't think it was so much just the headline CPI. I think it was the fact that they were seeing signs of inflation expectations starting to become a little bit more suspect.
The question is if they'll be able to deliver on the path that they've laid out for the next couple of years.
I think the Fed's forecasts are still remarkably optimistic.
All these numbers they threw out are fantasy land. The unemployment rate's fantasy land. The rate at which inflation is going to come down is fantasy land.
This is Bloomberg Surveillance, Early Edition, with Anna Edwards, Matt Miller, and Kaylee Lines.
It's 10 a.m. in London, 5 a.m. in New York, and 5 p.m. in Hong Kong on this Thursday, June 16th. Our top stories today. The Fed raises rates by 75 basis points in the biggest increase since 1994 and signals it will keep tightening aggressively. The SNB follows suit with a surprise 50 basis point hike. Elsewhere in central banking, the Bank of England is set to deliver a fifth straight rate hike later today, with officials expected to stick to a steady path. And leaders of Germany, France and Italy arrive in Kiev for talks with President Volodymyr Zelensky. It's the highest profile visit to Ukraine since Russia invaded at the end of February. Welcome to Bloomberg Surveillance Early Edition. I'm Anna Edwards in London with Matt Miller and Chrissy Gupta in New York. Kaylee Lines is off today. And Chrissy, what a day it has already been if you're just waking up in the United States. Sentiment here in Europe was already not great as we were getting started for the trading day. And then we got that surprise huge rate hike from the SNB.
You know, of course, it follows a lot of the turmoil that you're seeing in Asia. Let's go there and talk about the overnight action, because a lot of this has been simply a function of digesting a 75 basis point hike. Take a look at this. The MSCI Asia Pacific Index down again about 0.2%. But look, the volatility within that region is what really stands out, because if you actually look at what the different regions did, China, South Korea, they all sold off. But Japan, the Nikkei, actually gained a little bit, up 0.4%. And we know that's really been the region to watch. We're talking about the weakness perhaps in the yen, the weakness that you're starting to see in terms of the BOJ trying to really keep up with that hawkish temperature you're seeing around the world. But take a look at this. That I mentioned that weaker yen. Well, today it's a little bit stronger. Once again, reversing some of the trades that you've seen in the last couple of days. This idea comes back down to, even with these record imports, these record energy prices, can the BOJ actually seem to maintain a grasp on their bond market? And for now, for a very brief moment, Anna, it seems like they can, in light of those 75 basis point hikes. Whether they can actually keep that is a different story, Matt.
Yeah, we're going to find out overnight. What an insane week for central bank action, right? We get 75 instead of 50 from the Fed. We get an emergency meeting from the ECB, and now we could have the BOJ pulling an SNB, and we got an SNB pulling an SNB today. Right now, S&P futures down. This is really interesting because we're off big time, right? Almost 2.5%, more than 2.33% right now on futures. Yesterday, we rallied in the cash trade because the narrative was the Fed is finally getting control, finally going to quell inflation. Today, the narrative is, well, that's going to cause a recession. The U.S. 10-year yield rising as investors sell off this debt because later debt is going to come with a much bigger coupon. Right now, 338.31 is the level on the 10-year, but you can expect that to continue going much higher. NYMEX crude keeps coming down, which I guess is good for global growth, right? 114.95. As Joe Biden prepares to go to Saudi Arabia and talk to MBS maybe about getting some more oil. And then Bitcoin not doing a heck of a lot right now, 21,679. At least it's gaining, right? The concern was that it would fall down through a $19,000 support. And then the next support was below 15 or something, maybe even 0. So at least a little bit of good news for Bitcoin, and it's not correlated, it looks like today, but really it's all about central banks, right? That action just moved charts across the globe, Anna.
Yeah, absolutely. It's had a really big impact here in Europe. And it was interesting, in the first part of the trading session here in Europe, we thought maybe we'd get a little bit, Matt, of the post-Fed bounce in risk appetite that you were referring to there. But that certainly didn't happen. That certainly didn't last long. We were feeling negative sentiment coming through. NASDAQ futures were deteriorating even before we got the SNB hike. And then we saw the SNB hike and European stocks take another leg down. FTSE MIB down by just over 2%. The DAX down by 2%. The CAC 40 down by more than 2%. So this has taken the edge of risk appetite here in European stocks. This is the impact it's had on FX markets. We saw the Swiss franc jumping. This is the Swiss franc against the euro, and it jumped as a result of what we heard from the SNB. There were so few people expecting 50 basis points from the SNB. A few were talking about 25, but the sentiment or the consensus had been that we'd get actually no change. Well, that seems to have been blown out of the water, as has the assumption that the SNB would wait for the ECB to go first. That had been the sort of market's thinking previously. This is the German 5-year yield. We're seeing yields on the rise here, but this is not about spreads widening. That was the story of a couple of days ago, of course. This is the link between what the SNB is thinking about the ECB here and what the ECB is actually doing. So if the market is moving closer to a way of thinking that if the ECB has a fragmentation tool at its disposal, then it can do more rate hikes. Maybe the SNB thinks that's coming, and as a result, that's what the market is thinking. And we saw a jump in yields at the 5-year here. This is Germany, but we could have put in here Italy, we could have put in France. All across Europe, we're seeing those yields going higher. Natural gas prices also going higher, up by 7.8% this morning. We have all of these leaders, European leaders, making this really historic trip to Kiev at this time to meet the president, Zelensky. And Russia chooses that moment to cut back on flows, not cut back entirely, but reduce flows through the main pipeline. This is gas pipeline from Russia into Europe. ASOS, this is an online retailer, Chrissy, here in the UK. And for anybody who's thinking, well, all of that macro chaos can stay to one side, I'm focused on corporates, and they still have strong balance sheets, and consumers, yeah, they're feeling the pressure, but they've still got savings. Well, this is a cautionary tale from the retail space. Yes, there's competition for this business to keep in mind, but actually we're seeing very gloomy forecasts coming through from online retailers here in the UK now. This is ASOS. We also had a negative statement from Boohoo, which seems appropriate. Chrissy.
And ASOS, I didn't know it was a British brand. I think every American girl probably knows what ASOS is. Let's take a look at what's ahead today, though, and talk about those macroeconomic risks. German Chancellor Olaf Scholz, French President Emmanuel Macron, and Italian Prime Minister Mario Draghi are all in Ukraine for talks with President Zelensky. Senior European officials see little chance Russia will strike a deal to let Ukraine resume crucial grain exports. We'll get some U.S. data as well, including housing starts and initial jobless claims right off the heels of that Federal Reserve decision from yesterday. And speaking of those central banks, it's the BOE's decision, the Bank of England coming in at 7 a.m. New York time. Of course, we'll have that live coverage for you. And don't leave just now. We'll get the Bank of Japan decision overnight as well. Crucial, Matt, in terms of the central bank palooza we're seeing this week.
Yes, I like that. Central bank palooza. I'm going to stay up all night for the BOJ decision for sure. Let's get to our global team coverage of central banks. Francine Lacroix is in Zurich on the Swiss National Bank, Michael McKee here in New York on the Fed, and Lizzie Burden in London on the BOE. We'll start with Francine because that was unexpected, right? An increase in rates for the first time since 2007, and of any bank, the biggest first hike that we've seen so far in this cycle, Francine.
Yeah, this was so un-Swiss, but actually I flew into Zurich and a lot of market participants were like, this is the most exciting S&B meeting that we've seen in modern history. Well, they did not disappoint. So they hiked unexpectedly. Out of 20 economists, one, that was Citi was expecting a 25 basis point hike. We got 50 basis points. Now, the underlying reason, Matt, is of course they don't want to be left behind in this global tightening cycle. They worry about inflation. But remember, inflation here in Switzerland is 2.9%. So of course it's above their target, but it's peanuts compared to the rest of the world. So the question is, what does that mean for the Swiss franc appreciation? This was one of their main concerns in the past. And I think one of the other things, and this is something that Pictet just came out and asked in the Twitter sphere and also to a lot of their researchers, was this coordinated? We had a big day yesterday. We had a big week overall. And is this actually central banks coming together in IMF and saying, guys, we need to individually do something quite strong to show the world that we mean business, which is why we got the Fed. We did see the ECB on fragmentation. And today we have SNB as well.
All right, Francine, thanks very much for that. Francine Lacroix flew into Zurich, especially for the surprise hike. We got another hike out of the Fed, this time 75 basis points, the central bank's biggest hike since 1994. The chair, Jerome Powell, asserted the Fed's commitment to reining in price pressures, indicating another big move in July.
We're strongly committed to returning inflation to our 2% objective. Inflation has again surprised to the upside. Some indicators of inflation expectations have risen, and projections for inflation this year have been revised up notably. In response to these developments, the committee decided that a larger increase in the target range was warranted at today's meeting. Clearly, today's 75 basis point increase is an unusually large one, and I do not expect moves of this size to be common.
So just back from Washington, D.C., our international economics and policy correspondent Mike McKee joins us for more on the rate hike. Mike, pretty fascinating week for central banks, and the Fed didn't disappoint.
The Fed did not disappoint, as a matter of fact. They surprised, although they let us know on Monday through back channels that it was going to happen. The Fed has been watching inflation and were, according to Jay Powell, very surprised by Friday's CPI report in the United States, which showed the headline number up to 8.6%. And while the Fed looks at the core rates of inflation, Americans look at the headline rate because of gasoline and food. And with the headline rate rising, that pushed them into a big increase in inflation expectations, and that's exactly what the Fed is afraid of, and that brought on the 75 basis point hike, according to Jay Powell. Now the question is, what do they do in July? They've promised us another 175 basis points of tightening by the end of the year. The dot plot moving up significantly, and so they may do another 75 in July and 50 in September, which would leave them 25 to parcel out over the next couple of weeks after that, the next couple of meetings after that. But it's an open question, and a lot is going to depend on the CPI and PCE inflation reports that we get between now and then.
Mike, thanks very much. Bloomberg's Mike McKee on the latest on the Fed, from one central bank to yet another. The Bank of England is set to deliver a fifth straight rate hike today. Officials are expected to increase the key rate to the highest since 2009. Let's get more with Bloomberg's Lizzie Burden, who joins us from outside the central bank. 5 back-to-back rate hikes, Lizzie. That would be unprecedented.
It would, Anna, but I can't promise you the same policy fireworks that we've seen elsewhere in the world. You might ask whether the Fed decision last night would impact the Bank of England. Well, no, they've already had the vote, but as Mike said, there had been reports that 75 basis points might be on the cards for the Fed, so you never know what travelled across the pond. Here, though, the debate is more between 25 and 50 basis points, and that's because you've got inflation running at 9% here. It's swallowing wage growth. It's set to hit double digits later in the year. As the Treasury Select Committee Chairman Mel Stride said to Francine earlier, inflation expectations are getting out of control. People are losing faith in the Bank of England to do its job. And on top of that, since the bank's last decision, you've had another fiscal support package. But on the other side of the coin, the UK is in a recession in all but name. You've got the economy contracting, consumer confidence down, the housing market's starting to show signs that it's slowing down, and the same for the labour market. So our economists reckon you're going to land at 25 basis points, which some would say is pointless, others would say is cautious.
Okay, well, hawkish surprises do seem to be the theme of the week, and the weak pound has been having an impact on inflation here in the UK, hasn't it, Lizzie? So we'll have to wait and see. Lizzie Burden reporting from outside the Bank of England. Thank you very much. Let's stick here in Europe. Natural gas prices in Europe jumped after Russia stepped up an energy war by cutting supplies. Meanwhile, Olaf Scholz, Emmanuel Macron, Mario Draghi have all arrived in Ukraine for talks with President Volodymyr Zelensky. Let's get the latest from Maria Tadeo, our European correspondent. Maria, we've got these 3 leaders then visiting Kiev, one of the most high-profile trips by world leaders to Kiev then, and on the same day as that, we see Russia cutting back on supply of gas to Europe.
Yes, Anna, and we have, of course, Mario Draghi, Olaf Scholz, and Emmanuel Macron now in Ukraine, that train that got there this morning. And Anna, whether you believe this meeting is a little too late, whether they should have done this weeks ago already. Remember, the Ukrainians have for months now also pledged and asked them, come to Ukraine, see it with your own eyes, what the Russian aggression has done to our country. The pictures that we have from this morning, they really are extraordinary. These are the 3 biggest economies of the European Union, of course, all deciding to do this trip together, fly essentially to Poland and then get this train to Ukraine to show this sign of support. Now, a lot of this, of course, has symbolic nature, but we are being told that in this meeting that they will have to, with the Ukrainian president, there will be a conversation about weapons. There will also be a conversation about the EU candidacy for this country. Remember, the Ukrainians have had a major reality check on NATO, but they still believe they can one day join the EU, and that is their biggest policy priority at this point. And then, of course, it'll be interesting to see the language that we get from the German chancellor. Remember, he's been criticized for being too timid on this, for being perhaps at times too conscious of the German economic environment and the damage that could spill over from the war. Now, it's also interesting, Anna, Anna, that this is happening in a day in which Russia has decided to limit some of the gas supplies into Germany, of course, criticized by the German government, saying there is no reason to do this, just further instability in the region, and Russia is now playing politics once again with gas.
Bloomberg's Maria Tadeo joining us from Brussels. We thank you as always. And from Brussels, let's head over to Washington. The House committee investigating the January 6th assault on the U.S. Capitol by a mob of Trump supporters. Well, it's back in session today after postponing a hearing yesterday. Jack Fitzpatrick, our Bloomberg government reporter, joins us now from D.C. for the details. Jack, walk us through what we can expect today and what the latest is on these hearings.
So today's hearing is focused on the back and forth between then President Trump and then Vice President Mike Pence. They're going to focus today, they have said, on the amount of pressure that Trump put on Pence to overturn the results of the election on January 6th. We're going to hear testimony from Greg Jacob, who is the counsel to Pence, and Michael Ludwig, who was an informal legal advisor. They can get into the legal side of the back and forth and what Pence's understanding was of those voter fraud claims. We've already heard from a number of people that Trump was told that his claims did not have any legal merit. There is also likely to be video testimony from Mark Short, who is Pence's chief of staff. He may have some more information, not only on the legal side, but what Pence's team knew about any possible danger to Pence. In the first hearing, Liz Cheney cited White House aides who said that when told of a potential threat, even of hanging of the vice president, that Trump said maybe he deserved it. So we're going to get the legal side of the pressure that Trump put on Pence to try to overturn the election, but also potentially some more information about the danger to Pence and the relationship between Trump and Pence at that time.
Thanks to Bloomberg's government reporter Jack Fitzpatrick in D.C. Let's go from D.C. back here to New York and look at some of the stocks moving in the pre-market here, because this is going to be a very important story. If you see this broad sell-off in the market, what does the rest of it look like? And for that, I really want to look at Apple as this kind of proxy for tech broadly. If you don't have tech on your side, it's really hard to get those gains in the broader market. Apple shares already down to the tune of about 3% in the pre-market. Remember, higher rates are going to hit tech even harder. So Apple's really that proxy you want to watch for all of tech. But it's not just Apple. Let's talk about Tesla, because there are some fundamental stories in the play here. Tesla increasing their prices up to $6,000 across their lineup. That, of course, according to reporting, by Electric. This is really important as we talk about those macroeconomic issues that we've been hitting over and over and over again. Well, it hits companies like Tesla too, which does have a larger geographic exposure. Think China, think Berlin, of course, Austin, Texas, here in the States. All of that is going to hit their bottom line. Those shares down less than about 4% in the pre-market. Of course, Kroger, one of the few stocks in the green this morning. This is important. They're reporting earnings later. We've heard about the retail mania. We've heard about the issues hitting a lot of those grocers with food supplies. Well, right now they're saying Kroger could actually come in and beat their sales report. We're going to have all eyes on that, Anna, when it comes later this morning.
Could that possibly be an area of calm? Kriti, thank you. Coming up on this program then, live from the Super Return Conference in Berlin, we will be joined by BC Partners Europe Chairman Nikos Stathopoulos. He will be talking to us a little bit later on in programming. Danny Berger on the ground for us in Berlin. Plus, a Fed-triggered recession may cost Biden a second term. Bloomberg Economics now places the risk of a downturn at 72%. Read more about that link between the economy and politics in our Big Take story on Bloomberg.com, or by typing NI Big Take onto your Bloomberg terminal. This is Bloomberg.
city of Jamnagar is a money-making machine for Asia's richest man, Mukesh Ambani. His company Reliance has the world's biggest oil refinery complex here in the city. Jamnagar is also where Ambani is making his newest bet, a $10 billion investment in green energy. His ambition is closely aligned with the Indian government's plan to reach net zero emissions by 2070. But Ambani is not alone. India's second richest man, Gautam Adani, has committed $20 billion of investment over the next decade. But India's massive dependencies on fossil fuels have some environmental advocates questioning the realism and sincerity of those green ambitions and those of its two biggest billionaires.
Bloomberg has enhanced search on the terminal to deliver what you need when you need it. Now, you can simply type phrases in everyday English in the command line. Compare financials. Find people. Analyze markets. You can enter phrases or ask questions. What do you want to know today? Ask a question or visit SearchGo to find answers now.
This is Bloomberg Surveillance Early Edition. I'm Matt Miller with Kriti Gupta in New York and Anna Edwards in London. We are in the midst of an insane week for central banks. A surprise from the SNB to kick off the day today. Yesterday, we had an emergency meeting from the ECB. What was that all about? They got together to discuss the possibility of the justification for an extraordinary tool. I'm not sure, but if you look at Euribor pricing for ECB hikes, they shot up, and maybe that's why the SNB came out with its 50 basis point rate hike today. Let's talk about it with Dana El-Baltaji. She joins us out of London right now. Dana, what do you make of the emergency meeting yesterday? Is that what drove the SNB to this faster hike?
I'm not sure if the two of them are related, but I think what we can definitely see is that the central banks are realizing that they need to get ahead of the inflationary pressures. It's not enough to just do small hikes here and there. I think what they realize they need to do is to act quite aggressively in order to bring down this unprecedented inflation at a time when, we know that the economies are going to suffer, and we know that all of the reasons why the prices are going up can't really be helped locally. So they have to be super aggressive about it.
Yes, and with the ECB now giving us some sketchy detail about tools to tackle fragmentation, perhaps the path is clear for more rate hikes. We see the German 5-year yield heading for its biggest increase since 2011. Dana, thank you so much. More market analysis available to you on MLIV Go. That is the function to use on your Bloomberg terminal. This is Bloomberg.
When you think of cutting-edge technology at sea, you might be thinking of stuff like this. But there's an incoming revolution on the high seas that isn't quite as sexy, but could be significantly more impactful.
Container shipping is the key component of global trade. About 80 or 90% of all the world's goods are transported at sea at some point.
But there's a significant unseen cost to the modern era of global commerce.
About 3% of all the world's CO2 emissions come from shipping.
3% may not sound like a lot, but that's roughly comparable to the entire CO2 output of Germany. Since reducing trade isn't a likely option, what about a technological improvement to help reduce the emissions from these well-stocked maritime behemoths?
Access the financial world on demand. Hear from leading economists, policymakers, and industry experts via live and on-demand webinars, only from Bloomberg. Start exploring to see what's moving the markets. Visit Bloomberg.com/webinars.
It's really a reminder, isn't it, just how sensitive the markets are to any commentary about trade. We did see some pressure on the yuan, we did see some pressure on the futures. That is now being reversed.
Coming up, Hannah Gooch-Peters, Sanlam Investments Global Equity Investment Analyst. We're going to talk to her about the trade. We're going to talk to her about inflation. And this, of course, comes as German 5-year yields head for their biggest increase since 2011. What will Hannah say about how you play this market? This conversation next. This is Bloomberg.
That it's highly transmissible. We know that 2 doses of vaccines, Pfizer vaccine specifically, neutralize the virus, but not as efficiently because various studies showing that reduction up to 40-fold, meaning that a 3rd dose is a must for it to successfully neutralize the variant. What we don't know is still that what are the effects of mix and matching between vaccines and what are the capabilities of antibodies produced from this mix and matching in neutralizing Omicron. Because as we know, many parts of the world use different types of vaccines. And that would be a great data to look at. It will be also great to look at, because majority of the studies done uses a small sample number, and most of the time when you translate it to real world, the data changes. So it will be really good to look at large-scale data of the ability of antibodies from vaccines to neutralize this variant. Grateful here today that the virus, Omicron variant, still uses ACE2 receptor as its main entry. It means that all of the vaccines which are designed with spike in mind still works. Imagine if it uses a different receptor other than ACE2. None of the vaccines would work today. So I think that is the best news that we got from all these studies which came recently, the past couple of days.
Why do the biggest names in business choose Bloomberg?
That is a great question.
It's a great question.
It's a great question.
Great question.
Great question.
Great question.
Great question. That's going to be the best question I get all night. I'm glad you asked that.
Bloomberg Television. Top experts. Great questions. wherever you get your news.
This is Bloomberg Daybreak with Lee.
On Bloomberg Radio.
Welcome to Daybreak Australia. This is Bloomberg Technology. This is Bloomberg Green.
On TV, radio, and the web, this is Bloomberg.
This is Bloomberg Surveillance Early Edition. Here's what you need to know. The Fed raises rates by 75 basis points in the biggest increase since 1994 and signals it'll keep tightening aggressively. The SNB follows suit with a surprise 50 basis point hike. Elsewhere in central banks, the Bank of England is set to deliver a fifth straight rate hike later today, with officials expected to stick to a steady path. And the leaders of Germany, France and Italy arrive in Kiev for talks with President Volodymyr Zelensky. It's the highest profile visit to Ukraine since Russia invaded at the end of February. I'm Anna Edwards in London with Matt Miller and Kriti Gupta in New York. Katie Lyons is off today. And Matt, thanks to rate hikes that the market saw coming, but more importantly, rate hikes that the market did not see coming, risk appetite really deteriorating pretty quickly this morning.
Yeah, absolutely. I mean, we didn't even see the 75 basis point rate hike coming from the Fed until basically Friday afternoon, Monday morning, depending if you listen to Barclays or the Wall Street Journal. In any case, we were up yesterday, I think 1.5% in the cash trade on the S&P 500 because the market had already priced in that 75 basis points, and the narrative was that the Fed is going to get hold of inflation. Today, the narrative is that's going to cause a recession, and now we see pretty serious drops in S&P futures, 2.3% right now. Investors are also selling the 10-year, bonds across the curve right now, and that's pushing the 10-year yield up to 343.69. So levels that we hadn't seen really in over a decade. NYMEX crude is coming down right now, 114.48. Maybe the idea is, since China hasn't opened up yet, and if we're going to go into a recession, people are going to be driving less. I know I certainly will as I see prices at the pump. And then Bitcoin was up earlier, and I thought it was pretty cool because it was uncorrelated for the first time in weeks, maybe months, with futures. Now it's turned lower, but still at 21,249, well above the 19,000 and change level that Michael Novogratz has been watching out for. Kriti, what are you seeing in terms of pre-market movers?
Well, a lot of red on the screen, Matt, and this is really important when you talk about simply the proxy for that tech story. Apple, you got to keep looking at this, down 2.8% right off the bat. That yields picture, well, it is going to hit tech and it's going to hit tech hard. And take a look at this. It's not just Apple, Tesla as well, down 3.8%. But with Tesla, it's not necessarily a macro story, although perhaps you could say that it is. They are looking to raise their prices up $6,000 across their lineup. That's according to reporting from Electric. This is really important as we talk about how companies are going to actually perhaps pass on those costs that they're dealing from the macroeconomic sphere that you were just talking about. Let's talk about Kroger, though, because it's not all doomsday. There is a little bit of green on the screen, especially when you look at those retailers that can pass on those costs. Think about it. If you need food, if you need groceries, you're going to pay whatever it takes to get that food, and Kroger is going to be one of those beneficiaries. They're reporting those earnings later on today, and their expectation is they're not only going to beat those sales, Anna, but they're actually going to be able to pass on those costs even more.
Whatever it takes in grocery and monetary policy. Kriti, let's have a look at the European equity market picture. And stocks in Europe down by 2%. So to Matt's point about deteriorating risk sentiment, we certainly see that here in Europe. And actually, this was in train before we got that really unexpected hike in interest rates, 50 basis points from the S&P. Before that, we already had weakness on European stocks. We already had weakness on NASDAQ futures. So it wasn't all that, but it just reminded the markets of the threat of higher policy rates coming from global central banks. So stocks selling off. The euro on the move against the Swiss franc. This is the Swiss franc up by 1.7% against the euro as we see the central bank then in Switzerland surprising the market. The expectation had been that the ECB would go first, the SNB would follow its larger neighbour. That turned out to be the wrong sequence. The market knows that now, and the market had to adjust pretty quickly. Interesting to think about what this all means for the ECB. We saw them setting out some details, sketchy as they are, around fragmentation tools yesterday, or at least a focus on those fragmentation tools, and that seemed to put some calmness into peripheral bond markets. We still see that story fairly calm, but we do see a big pickup in the broader story around yields in Europe as a result of the assumption that if the ECB has the fragmentation tools, then that maybe means they can move faster when it comes to rate hikes. And so we see the German 5-year yield jumping to levels we have not seen since 2011. Gas prices also higher here in Europe today. We see a number of, 3 European leaders, the biggest European leaders from the biggest EU economies, making their way, and in fact they're there already, to Kiev to talk to to President Zelensky today, and that's the same day that we see Russia cutting back on its flow of gas supplies from Russia to Germany. So we join a few of those dots, perhaps, Chrissy.
Yeah, Anna, and that's going to be a major concern when you're talking about simply what the trade is. I mean, going into yesterday's 75 basis point meeting or move, the expectation was that if the Fed does this, will it re-enlist confidence in the markets 24 hours later, or almost 24 hours later, and you can see that futures, well, they're down 2.3% in the pre-market, at least here stateside. Let's get a little bit more color on what that actually means for the future of equities. Do we see that capitulation? Who better to ask than Hannah Gooch-Peters, Global Equity Investment Analyst at Sanlam Investments. She joins us now. Thank you, as always, for your insights. Let's talk a little bit about what the narrative is here. Now that we have 75 basis points, Powell perhaps talking about 50 or 75 in the next meeting as well. Can equity investors breathe a sigh of relief? And if not, or if they can, why are futures down so much today?
Now, look, I think when we saw the initial market reaction yesterday, I was starting to wonder whether or not this 75 basis points move was already priced in. Apparently not, and I think what we're now looking at is, due to Powell saying he's going to do what it takes to get inflation back under control around that 2% level, I think we're now seeing the real risk of another 75 basis point increase, and I think the market is now looking on that. We're looking at the effects of increased cost of capital. We're looking at effects on long duration stocks in particular, and as we've noted earlier in the program, we're now seeing, like the NASDAQ futures, for example, down around 3% today. So I think the market is still getting quite worried about that, and there could be some more downside to come.
Right, Hannah, good morning. So capitulation still lies ahead then. We haven't seen it yet. We've still got more downside for these global markets, it seems, and certainly US futures, as you suggest, pointing us in that direction. We're already in a global bear market for stocks. You wonder what it is that's going to suggest we are at the bottom. Does that not come until we get to a place where investors have really factored in all of the hawkishness that it's possible to factor in from global central banks?
No, look, at the risk of saying the worst thing I could possibly say, perhaps this time it really is different, because we're hiking rates into a stagflationary environment, and I just don't think that we're quite priced that in yet. I think that if you look at the discretionary sectors, for example, you can see the real pressures we're seeing on consumers globally. I think you're seeing financials starting to capitulate. You're seeing a really broad-based sell-off this month in particular. I really don't think there's anywhere to be hide. So for us, I think we could perhaps even see another 10% downside in the S&P in particular.
Okay, and so how long, in that environment, how long does this laser focus on inflation, this hiking cycle globally that we're seeing, how long does it last?
No, look, I don't know how long it's going to last. I think that we could actually see a recession particularly come forward to perhaps the end of 2023. Now, I spoke before how it might be 2024, but you know, we're raising rates quicker than I thought we would, and so and I think the market is having that same realization, and so I think things are coming forward a lot quicker than I thought we would. But you know, as you said, the market's reaction is very, very noticeable in the near term.
So Hannah, we're talking about then margin compression, to use a kind of jargony term, right? Which companies are going to feel it the worst, and where are equity investors safer to hide?
So look, we can see it already today. An example, we had ASOS's profit warning this morning. That is a company that was, if you bought it down in the lows of March 2020, you could have made over 500% of your money, but it's down 86% from its highs. You can see that pressure on the consumer. Companies like Amazon, for example, even Tesla, Apple, a basket of the biggest discretionary stocks in the world market from not holding those, the likes of Amazon, LVMH, Tesla this year, would have benefited a global investor over 2% in relative performance because they've been so weak. I think that's a part of the market that you are really starting to evidence these pressures on margins, for example, as you noted. We need to be looking to parts of the market that aren't as impacted by these inflationary pressures, and that's why we're seeing strength in large pharmaceuticals, for example, this year. Companies like Johnson & Johnson, Novartis in Europe, and even Bayer in Germany that are doing very well on a relative basis this year. But perhaps we have to start looking to other parts of the world too.
You know, having lived in Europe for 6 years, I still don't know what ASOS is, so I'm glad that Kriti appreciates it. In terms of car makers, with whom I'm very familiar, are we seeing, and all industrial or durable goods producers, are we seeing the supply chain problems solved? Are we seeing the chip shortage get better, Hannah?
No, look, I don't think we are. And I think semiconductors in particular were priced exceptionally high. If you look at the likes of ASML, NVIDIA, towards the particular start of 2021 for many of these companies were very, very, very expensive. And I just don't think that valuations right now in these car makers, for example, also the semiconductors, the larger parts of the supply chains are really quite pricing in these difficulties that we yet face ahead. They're coming off an exceptionally high base.
Hannah, thanks so much. Thanks for your time. Really good to speak to you. Hannah Gooch-Peters with their thoughts on global equities, global equity investment analyst at Sanlam Investments. Coming up on the program, live from the Super Return Conference in Berlin, we will talk to BC Partners European Chairman. This is Bloomberg.
I think what we've seen during this period of time is that communicating via video is not a fad. We are using it in all aspects of our lives, for work, for learning, for communicating, for staying in touch.
This is Bloomberg Surveillance Early Edition. I'm Matt Miller with Kriti Gupta in New York and Anna Edwards in London. And I'm kind of bummed out not to be in Berlin right now because the Super Return Conference is there. Normally, I go to that. Bloomberg's Danny Berger is there this year with Nikos Stathopoulos, BC Partners Europe Chairman. And Danny, you've been doing a fantastic job. Excited for this interview.
Yeah, Matt, me too. Look, I stole your gig. I stole one of your favorite interviewees. But so is life. That's right. We're here with Nikos right now. Nikos, thanks so much for joining. So last August, you spoke to Bloomberg, and you were pretty optimistic. You're saying, look, I don't think we're seeing any corrections right now, but I mean, the world is just so different from last August. Are you still optimistic?
I'm cautiously optimistic because naturally we're living in a very volatile environment. There's no doubt. Last August, I couldn't predict the inflation rates that we're seeing at the moment, and these are unprecedented. I've been doing this job for 25 years, and I have to say I have not seen inflation rates at this level, and I suspect most of my peers haven't. So we're living in an environment where inflation is much higher than we have ever seen for quite a while.
What does that mean? Obviously, it's hit public markets. What does that mean for private markets? Should they see the same drop in valuations that the S&P has, for example?
I would expect that we will, because the combination of inflation going up means that actually that will impact the profit margins of our businesses. It impacts the costs.
Any cracks of that?
We have seen some of the pressure on costs and pressure on margins on the businesses, but interest rates as well will impact our business because they will impact multiples, and multiple appreciation has been a key driver of the returns in our industry. So I suspect that we will see this adjustment in valuations. There's always a lag between the public markets and the private markets, so it might take 6 to 9 months. but I think it will happen.
Yeah, I know Matt wants to jump in with a few questions, but first, Nikos, I just do have to ask. Bloomberg News reported recently that your latest fundraising target, you missed the target. What happened? What went wrong, if you can talk about it?
I think the timing was not conducive, frankly. I think the combination of that and the current environment didn't help, but it hasn't changed at all our strategy. It's consistent to what we had before, and frankly, we're continuing to deploy with the same discipline as we've had before, so nothing much more to say, frankly.
Matt, jump in here.
Yeah, Nikos, one of the great questions that Danny has been asking other PE executives at this conference is, what are the conversations like that you're having with your portfolio companies, especially given the rising rate environment that we're in and the acceleration of that this week, in terms of costs, in terms of investments? What are you talking about?
If I caught the question correctly, Matt, you're asking what the costs and what we see in terms of investment.
What conversations you're having with companies right now?
I mean, there's no doubt that the cost pressure on our portfolio companies is seen now increasingly, and it's coming from all places. It's coming from raw material costs, wage costs, etc. So a lot of our task at the moment is to manage this cost pressure. Sometimes you can do so by pricing. Sometimes you cannot manage it 100%. So I think you might see some impact on the profitability. And I think generally what this implies, we'll have to work harder in order to make money for our investors. And I think we do need to make better what we buy. So our job has become harder.
In this environment, is there any sector that you wouldn't look at anymore? Has that outlook shifted, that a once attractive type of company in this new environment is no longer?
I think certainly sectors which have a lot of consumer exposure are sectors that we're a bit more cautious about by definition. You know, consumer spending has been impacted. Inflation is impacting every household. Energy prices is impacting every household. So that is naturally going to impact the consumer spending, especially in countries, even in the U.S., you know, where 2/3 of the GDP of the U.S. economy is consumer spending. So anything consumer-related, I think we're a bit more cautious at the moment. And we still invest in what we like to say being defensive growth sectors, like healthcare, like telecoms, media, like business services, where you can see that defensiveness, which we have been investing for 3 decades, and I think in this environment it's playing out even more.
Well, one of the things that this environment has done is the very bubbly type assets have suffered. I think of a Bitcoin. I know you're not there, not going to ask you about that space, but certainly SPACs had that feeling to it. Do you think those are just over now?
I think it goes to show that, you know, this SPACs, I don't know if they're over, certainly has been much more subdued. There has been activity still in SPACs, not as much as it was before. And I think it goes to show that people are much more cautious. And in this environment, frankly, I think they should be more cautious.
How does that caution translate to exits, selling to another private equity or IPOing?
The deal activity has not really been impacted so far. I think it might be as we observe what's happening with central banks' actions, etc. There's so much money still in our industry, so I think we won't see that much impact short term. But I think everyone is in a bit of a wait-and-see mode to see what the impact this will have, mainly on valuations. I think all of our peers, including ourselves, have still a lot of portfolio companies, and at some point we will have to exit those. So I don't think this activity is going to stop necessarily, but I think as in everything, you know, you have to adjust the valuation expectations of the buyers and the sellers, and they have to converge at some point, and that sometimes takes time.
Nikos, great to get some time with you. Thanks so much for joining us. Hope we can get you in the studio here in New York sometime this year. Nikos Stathopoulos there at the Super Return Conference in Berlin with Bloomberg's Danny Berger. Coming up later today, Greg Jensen joins us, Bridgewater Associates co-CIO. That's at 10 a.m. New York time, 3 p.m. in London. This is Bloomberg.
falling energy prices and a short supply of key chemicals that produce synthetic fertilisers are sending pig, cow and horse manure prices soaring. Even human waste is in demand as farmers hunt for alternatives. Fertiliser helps increase crop yields.
You can see how much moisture is held into this. It's a lot of organic material into the compost, so it breaks down. The manure and the straw breaks down into a friable mix that can be mixed into your soil in the ground and for growing a whole range of different vegetables. Holds the nutrients in, holds the water in, and it really increases the kind of biodynamic profile of the soil.
The recent price spike could mean more farmers going organic for the long term.
Lots happening on Wall Street.
It's the basic law of economics.
It validated what the market was already pricing.
Need to catch up?
This is Bloomberg Wall Street Week. I'm David Weston.
We've got the information and insights.
David, you just hit the nail right on the head.
From businesses most influential and instrumental.
And that's the way you run good risk management.
It's a challenging dynamic. We could continue to see that kind of strength.
Bloomberg Wall Street Week premieres Friday with replays all weekend on Bloomberg Television and Radio.
This is a market that over the past few weeks has made it clear it wants to go higher. It got a little spooked by the idea that geopolitical tensions are rising.
This is Bloomberg Surveillance Early Edition. I'm Kriti Gupta with Matt Miller in New York and Anna Edwards in London. You know, Matt, Anna, every morning Tom Keene asks me what my chart of the day is. Today, I have the distinct pleasure to ask him about his single best chart. Tom Keene, co-anchor of Bloomberg Surveillance, joins us now. Your single best chart, Tom.
Central bank roulette. Right now, the Swiss National Bank. I mean, it's really quite something to see what SNB did. I happened to be in Zurich with young John Farrow in 2015, the last time they did this. More drama then, but nevertheless, the chart speaks volumes. This is one of the most famous charts in the world. This is trade-weighted Swiss franc from 2007 with a massive appreciation of the Swiss franc. And then in 2015, they basically said, enough. And the success of their policy is the flatness. Slope matters on a log chart. And the real issue is with the price of the success of the Swiss model, massive appreciation. And since 2015, they have tried and tried and tried to manage the Swiss franc to a lesser appreciation. They threw in the towel today. Rates go up with the Fed, and maybe we'll see a stronger Swiss franc.
In terms of your guest lineup, Tom, what do you have today? I mean, it's hard to imagine beating yesterday's, to be honest with you.
Well, it's amazing right now. I mean, there's any number of news stories, including European leaders in Ukraine, which I think is just absolutely extraordinary. We're going to start strong with, well, the Bank of England. Elsa Lingos will join us, which is well-timed. And then on the market responses, Andrew Sheets will join us here as we stagger from central bank to central bank. When do we talk about the Bank of Japan?
Of course, something we're going to keep our eye on. Tom Keene, co-anchor of Bloomberg Surveillance, thank you so much. A theme that you're going to hear across central banks, specifically in the Federal Reserve dialogue, is going to simply be unemployment. And that's really what I'm watching today. The slew of economic data, initial jobless claims, Anna and Matt, that's what's on my radar. The idea that as you have more inflation, as you try to tackle inflation, will the American public, will investors actually accept the concept that higher unemployment may be necessary to tame down inflation?
And it could go much higher, right? I have to admit that I rushed home yesterday afternoon to watch John, Tom, and Lisa covering the Fed, and they had Scott Meinert on, who said, you know, the numbers that the Fed is working with are fantasy land, really. In terms of unemployment, it's going to go, I assume he meant much higher than they're forecasting. Nonetheless, what I'm watching is monumentally, historically important even. Ferrari is having its Capital Investor Day today, and they're talking about the electrification of their fleet. They're going to go with a full electric vehicle in 2025. They're showing the much hated SUV, the Puro Sang, to everyone there, although they're not unveiling it to the public until September. And they're talking about all the money they're making. We got an inside pick of the Puro Sang SUV that Ferrari is making. You know, there was a time when Ferrari swore they would never never make an SUV, and now they make one called Puro Sang. I just really don't get it, but it's going to be interesting for sure.
You see, I know you were torn today in this part of the program, Matt, where we tee up the things we're focused on, and I know that there is a part of you that is really obsessing about the BOJ right now. But I'm gonna go some way towards thinking about the BOJ. Well, not really, but I'm going to think about central banking at least, the Bank of England, and the Bank of England firmly in focus as we wait for a central bank rate decision, another one in what has been an already busy week. Will we get a fifth back-to-back increase in interest rates from the Bank of England? That would be, as we heard earlier from Lizzie Burden outside the Bank of England, that would be unprecedented. It would take us up to 1.25%, which I cannot believe. I had to read this twice. This is a 13-year high for rates, 1.25%. So low have rates been for so long. Will there be three dissenters going for a 50 basis point rise, or will the Bank of England be held back by the fact that we've seen two negative prints on GDP back to back? That's month after month, so not quarter after quarter, but still something that could weigh on those policymakers. Or will they, Matt, catch the zeitgeist
I feel like
and go with the hawkish surprises?
I feel like the Brexit vote was 13 years ago. Is that right?
No, that was only six
years ago. And yet we're still dealing with the fallout. It's so lovely. Yeah, no, we're seeing a lot of superlatives when it comes to central banks. And look, on Friday we had University of Michigan consumer confidence here in the U.S. out at an all-time low, which is one of the reasons that you're seeing the central banks move with such trepidation, right? It's hard to raise rates into that kind of issue. We heard from Lizzie Burden that the UK may already be in a recession, so it's difficult to raise rates in that environment.
Yes, and to Critty's point, we keep watching labour markets because they've been an area of brightness, of course. If that starts to show cracks, then that really does change the narrative. That is it for Early Edition. Still focused on central banks, on surveillance. That lies ahead. This is Bloomberg.
When you think space, you probably think one space agency that travels under the radar is ESA, which is surprising considering what the European Space Agency has achieved and how vital it is to the global space industry.
We've collaborated with pretty much everybody who is involved in space exploration.
ESA wants to be a leading force in furthering humanity's mission into space.
Commander Ground, do you copy? Copy.
If we want to have successful human missions to Mars, we are going to have to learn to live and work off-world in a different way. The place where we are going to learn to do that is on the moon.
Can ESA help humanity take its next giant leap?
Front Row, exclusive interviews with the most influential figures in finance. Lloyd Blankfein.
Deflation is a terrible thing. Inflation you could tolerate.
Kathy Wood.
Tesla will be in the pole position to dominate.
Jeremy Grantham.
We've had a very, very abnormal honeymoon Goldilocks period.
First available on the Bloomberg Terminal, then on Bloomberg Television and Bloomberg.com. Front Row, the best seats in the house for business's greatest minds.
big change from the Fed.
The Fed definitely caught up with the market pricing of rate hikes for the next couple of years.
I think the Fed's forecasts are still remarkably optimistic.
Fed rate hikes just take a really long time to impact the economy.
All these numbers they threw out are fantasy land. The unemployment rate's fantasy land. The rate at which inflation is going to come down is fantasy land.
This is Bloomberg Surveillance with Tom Keene, Jonathan Farrow, and Lisa Abramowitz.
The sell-off resumes from New York City for our audience worldwide. Good morning, good morning. This is Bloomberg Surveillance Live on TV and radio alongside Tom Keene and Lisa Abramowitz. I'm Jonathan Farrow. Futures negative, more than 2%. TK, the S&B behind us this morning. The Bank of England up next.
Yeah, it's every central bank for themselves, and you wonder where the Bank of Japan slips into this. John, the set of news here right now is so extraordinary that we need essentially to stagger from the hawkish out bank by bank by bank. How do these hawkish bankers, led by Chairman Powell, deal with the OECD 2.8% global growth next year? Is it a forced recession? Is it a forced global slowdown? That's the bigger picture this morning.
What did Scott Minerd say yesterday, Tom? We saw it there in the opening part of this program. Fancy land again. He does not believe in those forecasts by this Federal Reserve and believes they could be a whole lot worse.
Mr. Minerd has an opinion, but far more importantly, John, we need to redux what Bill Dudley said yesterday. Zero Hedge led with our interview yesterday in their postmortem. And the answer is the president of the New York Fed, the esteemed William Dudley, was scathing how this is a rose-colored view.
Rates are going up, yields are going up. Lisa, the market's doing the talking this morning. Equities down, yields higher, not just on treasuries. Look at bonds. A 10-year bond, 180, up 18 basis points on the day.
The ECB is going to have to act, and that's the clear message that we got. Also from the S&B, the fact that the Swiss National Bank raised rates for the first time in 15 years, and not by 25 basis points, but by 50 basis points, by 0.5%. How much does this put the pressure on the ECB, saying it is your turn? Everybody, except for the Bank of Japan, is responding to this inflationary wave. You do too.
The second time we've seen this, Lisa, a big rally on Fed Day, and then a big sell-off the day afterwards. It's almost as if we're fading something, then not quite buying it afterwards. It doesn't really add up, does it?
Yesterday's move didn't really add up. We were talking about that. There was nothing in the statement, there was nothing in the press conference to give risk assets any comfort whatsoever, and we heard that from strategist after investor after economist. This is basically the Fed saying we are willing to risk a recession in order to get inflation under control, and that is not a comforting message for risk assets.
Equity futures right now down around about 2%. Let's whip through it for you. On the NASDAQ 100, we're down by 2.6. Keeping a close eye on what's happening in the bond market here. Yields high by 15 basis points to 340, 369. Just yesterday in reverse in many ways. In the FX market, euro dollar clinging to 104. The first rate hike from the S&P in 15 years, Lisa. It's been a while. Euro dollar negative 0.4 to 1%.
And so now the Bank of England is up at 7 a.m. with that rate decision very much in the forefront. The expectation here is for them to move possibly by 0.5 percentage point at the 5th consecutive meeting that they will be moving and raising rates at a time where they're raising rates into weakness. The pressure is on to raise rates, and I know that, John, you've been talking a lot about this, how there is a need to defend the strength of a currency, which is a complete reversal of what we have seen over the past few decades. What we're seeing today is the pound losing steam. We have seen that consistently weakening versus the dollar. It's also weakening versus the Swiss franc. Again, it's a race to see tightening from the central banks in order to support the currencies, and that is what you're seeing today with the pound losing at 119 versus the Swiss franc. At 8:30 a.m., we get U.S. building permits and housing starts, as well as U.S. initial jobless claims. The U.S. unemployment rate very much in focus right now, given the fact that we're at 3.6%, near a historic low in the unemployment rate. Basically, Fed Chair Jay Powell conceded yesterday the unemployment rate has to go up. What's the projection right now? 4.1% unemployment rate in 2024. Perhaps that is fantasy land. Perhaps, as Bill Dudley said, they need to indicate more pain ahead. Right now, this is the pain point. How many people will have to lose their jobs in order to get inflation under control? And today, German Chancellor Olaf Scholz, French President Emmanuel Macron, Italian Prime Minister Mario Draghi, all heading to Ukraine for talks with the president there. This as natural gas prices surge yet again in the euro region. How much can you get inflation under control, John, when you have that geopolitical risk hanging out there and the conflict continuing to brew?
Europe has so many problems. Lisa, thank you. Arcelinios joins us now, the global head of FX strategy at RBC. Alsa, let's start here. Do you think we might be in the foothills of a currency war?
I wouldn't term it a currency war because what banks are trying to achieve, what central banks are trying to achieve is very different. Here, actually, currency strength can be a good thing in that it helps you target imported inflation, whereas typically we think of currency wars as trying to artificially weaken your currency.
That's what I'm trying to get at, Alsa. Is it the last decade in reverse? Is this a very, very different kind of currency war compared to what we've seen in the past? A currency war, nevertheless, but with a different objective, and not everyone can win.
Well, I guess the difference here is that we're not going to see active intervention, with one or two possible exceptions. I mean, we've talked a little bit about the Bank of Japan, but we're not going to see active intervention in order to generate a stronger currency. But we will see is central banks taking into account the impact of policy on the currency and how they can generate that higher imported, lower imported inflation. So I guess I wouldn't call it a currency war because the currency isn't going to be the main tool. But certainly, I think where you're absolutely right, central banks are going to be far more comfortable looking for a stronger currency against their peers.
Also, to borrow from the wonderful William Rhodes, is this coordinated? Is Powell central banker to the world, or is the bond market central banker to the world?
Well, at the moment, it feels like global inflationary pressures have the upper hand, right? And that's, I think, what we heard yesterday. In traditional times, central bankers would focus on core inflation because that's the best predictor for future inflation. And yet, at the moment, with headline so high relative to historic periods, we're actually seeing that feed through into inflation expectations. And that's really what has central bankers worried.
Right now, we're also looking at a race to tighten rates the quickest in order to deal with the inflationary input. How much do you think, perhaps to John's point, we're not necessarily going to get a currency war, but we will get pressure from central banks and other central banks to raise rates simply to keep pace, to not increase the inflationary pressures in their economy?
Yeah, and I think that's what we saw this morning with the S&B. I mean, that's really notable. As you said, first time in 15 years they're raising rates. And this is a central bank which up until very recently was actively intervening, trying to weaken their currency, really targeting a much weaker currency over a very long period of time. And here we have the central bank just stepping away and not just hiking rates, but surprising markets with a larger than expected hike. That's a very clear signal of intent. And like you say, it does create some pressure whether or not others will choose to follow.
Elsa, what do you expect the ECB will do in response to this, given the fact that you are seeing that tightening from even the Swiss National Bank? Are they going to come out and surprise to the upside? And will that be positive or negative for the euro?
They're in a really difficult spot, right? And here is where you see the impact of making monetary policy for such a disparate group of economies really coming to the fore. Because yes, on the one hand, they'd like to go faster. They do have the same inflationary problems a lot of people do. If anything, commodity prices are much higher in Europe than they are elsewhere in the world. But then at the same time, as rates go up, that's causing a lot of pressure on the periphery. And so yes, we heard that kind of extraordinary meeting yesterday. They promised to come up with some new tool, no details as yet. I do think that the fact that they're considering fragmentation will actually keep them near the back of the queue in terms of hiking rates. And so I've got to say, from a cyclical perspective, I'd be a little bit more negative on the euro.
Also, what does EM do here? I mean, away from the major currencies and the power of these economies, the sophistication of their financial systems, forget about Ecuador and Bitcoin, or I think, no, Costa Rica. I can't remember which one, John, is based on Bitcoin right now. Yeah, El Salvador, excuse me. Okay, forget about that. But what does EM do when the big boys are lifting rates?
So I think the hope for a lot of people was that if you rewind back a few weeks, the narrative was you had temporary lockdowns in China, but you've got the Party Congress coming up in October, and we were expecting, or markets were expecting, there to be big fiscal stimulus delivered ahead of that. But what we're seeing in practice is that zero COVID policy is very difficult to execute, and what you'll keep seeing is ongoing flare-ups and renewed need for restrictions and lockdowns. And so I think with China somewhat on the sidelines, that really puts the rest of EM in quite a tricky position. You know, we saw that with the BCB. They have been looking to end their tightening cycle, but it's very hard to do when the currency is coming under so much pressure.
Elsa, thank you. Elsa Linios there of RBC. Lisa, we've got to fully realise some really, really big issues. It's the last decade in reverse. We're now trying to engineer stronger currencies after trying to engineer weaker ones for the last 10 years. Not everybody's going to win that game. And I think we're seeing that play out in foreign exchange right now.
You know, you said it really well yesterday when you said that it was the race to the bottom, and it was a much easier race when that was the case, when there was no inflation for the central banks. This is a very uncomfortable race. Is it a race to tighten policy the most? And then at what point is that going to be negative for currencies if that indicates even slower growth going forward?
Central bankers, Tom, don't like to talk about the FX channel, but if you import so much inflation, I think the Bank of England in focus a little bit later this morning for us. When you do that, the FX channel is so important. What remains to be seen for me is if the Bank of England went with a bigger rate hike today, would it do damage to the currency, or would it actually be positive for the currency?
Yeah, this is really, really important, folks. And this is a cultural aspect, a political aspect, and also just the simple, blunt differences of these different economies. John, I totally agree that currency analysis here is important, but I would look at the magnitude historically, and as was alluded to yesterday in our conversations, we really haven't seen a magnitude move in rates yet. We are hawkish. Everybody's having, to borrow from Bart Simpson, the economist, a cow about it. But John, we've just barely begun to move.
We've got a central bank forecasting higher unemployment, Lisa. That's always an uncomfortable moment for any central bank that has to do that.
And they kicked him up to, what, 4.1% by 2024?
Yeah.
And what did Bill Dudley say? Still fantasy land.
Still fantasy land.
Not real.
Scott Minard said the same thing. With Lisa Abramovich this morning, I'm Jonathan Ferro, together with the man from Del Monte. And if you're not British and you don't get that joke, Google it. From New York, futures down 2% on the S&P. This is Bloomberg.
First squeeze tang.
Keeping you up to date with news from around the world with the first word, I'm Ritika Gupta. The leaders of Germany, France and Italy are in Kyiv today for talks with President Volodymyr Zelensky. Olaf Scholz, Emmanuel Macron and Mario Draghi traveled together by overnight train in a show of solidarity for Zelensky and his government. The trip comes ahead of an expected recommendation Friday from the European Commission that Ukraine be granted candidate status to join the EU. And some NATO members are looking to Germany for cues about how to boost the alliance's defenses against Russia. Bloomberg has learned the allies are considering adapting a new German model in their long-term defense planning. Germany's been identifying units that can be deployed to Lithuania at short notice and placing key equipment ahead of time. It's an alternative to basing new troops more permanently in the most vulnerable member states. And the House committee investigating the January 6, 2021 insurrection of the U.S. Capitol will focus today on the pressure then President Donald Trump put on Vice President Mike Pence to block congressional certification of Joe Biden's presidential election win. The panel will hear that Trump was repeatedly warned his plans were illegal. The hearing may include testimony from Trump aides that when Trump learned rioters invading the Capitol were calling for Pence's lynching, he responded by saying Pence, quote, deserves it. The chief White House medical advisor, Anthony Fauci, has tested positive for COVID and is experiencing mild symptoms. He has not been in close contact with President Biden or other senior government officials, but will self-isolate and continue to work from home. The 81-year-old is fully vaccinated and has been boosted twice. Global News 24 hours a day on air and on Bloomberg Quick Take, powered by more than 2,700 journalists and analysts in more than 120 countries. I'm Ritika Gupta. This is Bloomberg.
worries about what they call black soot, caused by the manufacturing and consumption of these fuel products in the illegal refineries.
Oil theft, known as bunkering, and the refining of its spoils is worsening the damage from decades of fossil fuel exploitation, creating one of the world's most severe ecological disasters.
Our sacred forests, our homes have to give way to oil wells, and no one gets much benefit.
Imagine a resident of Port Harcourt who inhales this soot every second in 24 hours, 7 days a week, 30 days in the month, and for years now, we are dying slowly but surely, and our lifespan is reducing every day.
Bloomberg has enhanced search on the terminal to deliver what you need when you need it. Now, you can simply type phrases in everyday English in the command line. Compare financials. Find people. Analyze markets. You can enter phrases or ask questions. What do you want to know today? Ask a question or visit SearchGo to find answers now.
This June, in honor of Pride Month and Juneteenth, Bloomberg brings you a special equality series every Thursday in June at 1 p.m. Eastern. Bloomberg Equality, celebrating inclusion this Pride Month and all year long.
I do not expect moves of this size to be common. From the perspective of today, either a 50 basis point or a 75 basis point increase seems most likely at our next meeting.
That seemed to be enough to lift this equity market. It just didn't last long.
Just rocked, yeah.
Fed Chair Jay Powell.
How about that rally?
At yesterday's news conference, it fades, Tom, and fast. We're down 2% on S&P 500 futures. On the NASDAQ 100, down about 2.5. Looking at crude, negative about 0.25%, 115. The president wrote a letter to some of the big oil players. The White House did. Exxon snapped back. I'm just going to bring you some of the numbers that Exxon delivered. Here's one quote. We kept investing even during the pandemic when we lost more than 20 billion. They wanted to emphasize that and had to borrow more than 30 billion to maintain investment to increase capacity to be ready for post-pandemic demand. They make all these points, Tom, about investing in America, et cetera, et cetera, et cetera. Then they have some tips for policy at the end. The letter concludes by saying, longer term, government can promote investment through clear and consistent policy that supports U.S. resource development. Tom, a bit of a snapback from Exxon yesterday.
A bit of a snapback, and it's really off the radar this morning. Brent crude 124 down to 118. I guess it's a give back. But John, within all of this battle over commodities and particularly hydrocarbons, I saw Jeff Curry with us earlier this morning on Bloomberg. John, European nat gas speaks volumes. It's not out to February 24 in the beginning of the Ukrainian war, but it's day by day there's a different hydrocarbon to get your attention.
And the news from Gazprom, I think it was yesterday, Tom, maybe just restraining some of the supply into Europe. Might not be a massive story for the Europeans right now, could be an even bigger one further down the road.
Right now, we are going to digress, and this is a story that I think internationally needs to be told. Richard Nixon was buried in 1967. There was a small matter of a war in Vietnam, and he resurrected his political career with a war on crime, and it worked. Jeff Fitzpatrick joins us right now with a Republican formula that was shocking on Tuesday. Jack, this is from Brownsville to Corpus Christi, Texas, and on the grave of LBJ, the arch Texas Democrat, the Republicans are winning, and I would suggest winning big, worried about crime, worried about the border, just worried about getting that Hispanic and black vote they're not supposed to get. This is a seismic change for American politics, isn't it?
It represents a lot of significant things that look very bad for Democrats. This special election that went to Mayra Flores pretty unexpectedly, the Republican who won the special election for Filimon Vela's seat. There's still going to be a competition in November because this is replacing someone who stepped down. But one, it shows you that, Democrats on one hand have not necessarily put a ton of effort into a state like Texas, despite maybe their dreams of turning that blue presidentially someday. Two, they already knew they had bigger problems than they initially thought with Hispanic voters at large, especially looking to Florida, more conservative Cubans. But they can't lean back on some opposition to Donald Trump now that he's not president. The border wall debate is not in the news cycle. It's not an issue right now. And it raises questions about what kind of demographics the Democratic Party may have taken for granted for a long time that they haven't organized around and sent a message directly to in recent years.
I am absolutely fascinated how President Biden, and let's assume for the sake of discussion he's a one-term president, how does he lead his Democratic Party back to the assumption of Hispanic and Black ownership? They're leaving in droves. Statistically, it's irrefutable.
Some of this, it's a bit of a patchwork. It's very difficult to pin down, when we say that the Democrats are struggling with Hispanic voters, that is such a broad group with different subgroups that it's very difficult to point to a reason. One of the bigger reasons, and maybe this is more of a Florida issue than a Texas issue in this one special election, but it does largely come down to economic views, at least in some cases. If you're running on a weak economy, you can lose a lot of voters who you may have taken for granted in recent years. You're also right to raise the crime issue that affects them in many places around the country. Biden has probably dragged the Democratic Party back toward the center in how they talk about police and that kind of thing, but it is still a tough issue, and it's going to be a tough series of midterms.
John, I can't say enough about, for a certain vintage, this vote Tuesday was absolutely stunning on the Texas Gulf of Mexico border. It's once in a lifetime kind of vote.
Jeff Fitzpatrick down in DC, TCAL was following the same thing. More broadly, going into the midterms, Lisa, just things heading in the wrong direction for this president on a whole series of issues.
Well, and Tom asked the question, how does this president lead with respect to getting Hispanic and Black votes? I could make the question much broader than that. How does he lead if so many people are saying that he's going to be a one-term president? Not very long ago, the expectation for recession this year was nil. Now it's something like 70% if you take a look at Bloomberg Economics projections. So how does he lead when so many people are saying he's inevitably going to be a one-term president?
You ask the perma bears about the economy, they'll tell you the same thing every single time. When you see slightly constructive people or more than constructive people turn quite negative on the outlook, that's what gets my attention. To hear from Neil Dutta yesterday, to hear from him in the news conference and really raise some questions about where this Fed was heading in a not very constructive way. To hear from Wells Fargo, almost as the news conference finished, they put out this note. Indications that inflation is becoming more entrenched in the U.S. economy has caused the Federal Reserve to become even more hawkish. We now judge that recession next year is more likely than not. More likely than not, Lisa. This is what this market's been adjusting to now for weeks, if not months.
Yeah, that Jay Bryson note caught my attention as well, because they said that they expected a soft landing just a week ago, now no longer. And how much does the Fed respond to that by saying, you know what, maybe you're right, but we have to get inflation under control? And that was the message yesterday. To me, the biggest takeaway, and it was not the stock market rally or the bond market rally, which we rejected yesterday, is not really necessarily cohering with the message from the news conference, but really this idea they are willing to risk recession, period. End of story.
They will never talk about that openly, though, Tom. They will never talk about that openly, and they're never going to forecast it either. So I don't think we can complain too much about that. We can't complain too much about that. Fact of the matter is, for a lot of people, their view on the Fed has changed. They've had to change the timeline. I think they've had to change the destination as well. the peak and ultimately what that's going to mean for unemployment
I'm
versus,
focused
say,
on the timeline,
growth.
and so is Ellen Zentner. I thought her note this morning was just absolutely brilliant. I took some real shade yesterday, John, from people thinking I'm over-analyzing a two-part inflation. There's a path from 9% to whatever percent, and then it's the move from that lower percent down to 2 or 3 that's going to be so difficult. Ellen Zentner looking for steeper vectors right now.
Futures on the S&P negative a little more than 2%. NASDAQ 100 futures down by 2.7. Yields biting back up 15 basis points. Heard on radio, seen on TV, this is Bloomberg Surveillance.